There we go. All right, well, we can hear you well. We can see your slides. So it is 8 o'clock in Wisconsin, 6 o'clock in Las Vegas, and 9 o'clock in Michigan. So ready to roll. Good morning, everyone. I'm Stephanie Fisher with the Education Department in Michigan. Welcome to all of our Michigan bankers and special guests, our Wisconsin bankers today. So we're delighted to have you on. If you have not been in David Osborne's training, you know he makes this as interactive as possible. So keep an ear out. He will probably call your name today. So just want to make sure that you're getting your questions answered. You can use the chat or verbal. David will go over that. Our schedule, we will wrap up at 2 Central, 3 Eastern today. David will talk about your breaks and your lunch, of course, as well. I did want to let you know that tomorrow, David is presenting advanced tax return analysis for us, same time, same place. And then Friday, advanced CNI and CRE lending. If you're interested in either one of those, you can reach out to myself or Lori in Wisconsin as well. You heard we are recording, so if you have to step away and miss something, I will be sending out a recording to you. I'll also send you a Survey Monkey so we can get your feedback on today's training and any future topics that you need, of course. One last thing, David is joining us for business lending on October 7 and then loan officer sales training on October 8 if you are interested in need any of those or for your team as well. So I'd like to introduce David L. Osborne, MBA, CCRA. He is the founder of Osborne and Associates, LLC. A business training and contract CFO firm that provides training, speeches for bankers, CPAs, credit managers, attorneys, and business owners around the country. His extensive professional background of over 30 years includes 21 years as a business trainer and contract CFO, 16 years plus as a bank commercial lender, including the position of VP, senior banking officer. And he is also a college professor with over 30 years. Let's see, including the College of Southern Nevada as well. So welcome, David. We're delighted to have you.
Thank you so much, Stephanie, and welcome everyone to today's session, Advanced Financial Statement and Cash Flow Analysis. My name is David Osborne. It's great to be with each one of you. We're going to start off with doing our introductions, and we do have a good-sized class today. We have our group from Michigan and our group from Wisconsin. And so we're going to start with the Michigan group, and then we'll go to the Wisconsin group. So what we need is your name, and if you would go ahead and if you can just shout this out, your name, and you just unmute yourself, of course, your name, your bank. What do you do in the bank? What's your main function? Not necessarily your title, but your main function. And then lastly, on a scale of 1 to 10, 10 is the highest, 1 is the lowest. 10 is the highest, 1's the lowest. Where would you put yourself with this theme of today's topic? Financial statement and cash flow analysis. And I do want to emphasize, pardon me, we're amongst friends. So don't hesitate. Just tell us your number. You can be anything in between. 10's the highest, 1's the lowest. What number are you at? And we'll start with Jordan. And now I do emphasize, there may be a few of you that cannot participate via the audio. So that's fine. We'll use the chat, but let's save the chat only for those individuals that cannot use the audio. So if I ask a question, don't respond in the chat if you have the audio, of course. So Jordan, or if you're with us, if you can unmute and give us your introduction, please.
Hello, my name is Jordan Braun. I'm with Grand River Bank in Grand Rapids. My main function, I'm a commercial credit analyst there. scale of 1 to 10, on this particular topic, I'd say I'm probably a 6 or a 7. I'll go 6 just to leave myself more room to learn.
Okay, great. A 6, excellent. Okay, Dwight, are you with us, please?
Hey, David, it's Dwight. I'm with County National Bank in Jackson, Michigan. Evan and Mo are with me as well. Morris are with me.
Okay, great.
I'm a commercial credit analyst as well. I'd say probably a 7 on
Okay.
this topic strain.
Great. Thank you, Dwight. Maurice, if you'll go ahead, please.
Hi, my name is Morris Jones. I am a commercial credit analyst with County National Bank. And I would say my number is probably around a 7 or 8 as well.
Okay, great. Thank you. And you're in the Grand Rapids area as well?
In Jackson.
Yeah.
Oh, you're in Jackson. I'm sorry. That's right. That's right. You're in Jackson, both of you. Okay, excellent. Thank you. Morris, thank you. And Andrew, are you with us, please?
Yes, I am. Andrew Ketron. I'm with Oxford Bank in Oxford, Michigan. I am an underwriter, and I would say I'm a rank 8 or 9-ish.
Okay, excellent. And Andrew, what part of the state is Oxford in?
Southeast Michigan, probably about an hour and a half northeast of Ann Arbor.
Okay, great. Thank you. And Charisma. Charisma, are you with us?
I am. Can you hear me?
Yes, excellent. Loud and clear. Excellent.
My name's Charisma Lubinsky. I work for First National Bank of St. Ignace in the Upper Peninsula. I'm the credit analyst here, so I analyze the financials of our commercial loans or loan applicants. And I would say I'm a 5 or a 6.
Great. Thank you. Catherine, are you with us? Catherine?
Yep, I'm here.
Go ahead, Catherine.
I work for County National Bank, but I am located in the Adrian-Tecumseh area, and I am a commercial credit analyst also.
Okay, great. And what number are you? What number would you give yourself?
I would say about a 6.
About a 6. Okay. Okay, great. Ryan, how about you?
Hi, I'm Ryan. I work at Bank of Ann Arbor. I'm a level 1 credit analyst, and for my strength, I'd say about a 6.
About a 6. Okay, excellent. Joey, how about you? Pardon me, Joey. Go ahead.
Yeah, can you hear me?
Yep. Mhm.
Awesome. Hi, my name is Joey Merlino. I'm currently at Superior National Bank, Troy, Michigan, as a credit analyst, and I would say I'm about a 6 as well.
About a 6. Great. Credit analyst, good. And Evan, how about you?
Hi, David. I'm in Jackson, Michigan at County National Bank with Dwight and Maurice. I just started as a credit analyst here about a month ago. So I would say on the scale, I'm probably a 5.
About a 5. Thank you, Evan. Okay. And let's see. Wait a second. I just realized we've got 2 Catherines. We have Catherine Lee and Catherine Walker. Is Catherine Walker with us, or did you already give your intro? Let's see. Catherine Lee, did you give your intro? We had one of the Catherine do your intro already.
Yeah, Catherine Lee already went.
Okay. And is Catherine Walker with us? Okay. Let's see. Checking the chat. No. Okay. So not Catherine Walker. Catherine Lee's done. Okay. Jeremy, are you with us? Jeremy from Michigan.
Yes, I am. Good morning, everyone. My name is Jeremy Smoot. I'm a financial analyst with Michigan Business Connection, and I would have to rate myself a 7.
A 7. Okay, excellent. Now let's go to the Wisconsin group. Matthew, are you with us? If you'll give us your introduction, please.
Hey, my name is Matthew Bennett. I work for People's State Bank, and My job function would be underwriting loans to ensure that their credit quality is good for the bank.
Great. And what number would you give yourself?
I'd probably rate myself about an 8.
About an 8. And what town are you based in?
I am based down in Wauwatosa. The bank's actually, based out of Wausau, Wisconsin, though.
Okay, but Wauwatosa, right?
Yep.
Okay. Excellent. Hannah, how about you? Hannah, are you with us?
Yep, I'm here. My name's Hannah Cowan. I work with Citizen State Bank based out of Cadott, Wisconsin. I'm one of the region managers here and I oversee mostly the deposit side in retail. So I would give myself probably a 3 on this topic.
Okay, a 3. And what part of the state are you based in?
Around near like Eau Claire, Wisconsin, I would say is one of the larger cities.
Okay. You bet. Great. Thank you. Brad, how about you? Brad, are you with us? Okay. And Christy, are you with us? Christy? Heather, are you with us from Wisconsin? Heather, are you with us?
I am, yeah.
Go ahead, Heather.
My name is Heather Herbst. I'm from Ergo Bank in Marquezan. I'm a credit analyst and I would give myself a number 6 on the topic.
Great, a number 6. And what part of the state are you based in?
Central.
Okay, great. And James, how about you?
Hi, I'm James Crow Kramer. I work at People's State Bank out of the Wausau branch. I'm a credit analyst there. I'd probably rate myself probably a 7 or 8 on this topic.
Okay, great. Carly, how about you? Pardon me, Carly, are you with us? Carly? Okay, Alexa, are you with us? Alexa, are you with us? And Zachary, are you with us?
Yep, my name is Zach Rose. I work for CCF Bank out of Eau Claire, Wisconsin. I am a credit analyst and I would rate myself probably a 7.
A 7, okay. And Angela, are you with us?
I am. Good morning.
Good morning.
My name is Angela Wheeler. I'm a commercial credit analyst for CCF Bank. I actually work out of not out of Rice Lake, and the main office is in Eau Claire. I would probably rate myself like I don't know, an 8, 7 or 8.
Okay, great. Thank you. Now from the chat, let's see, we've got a few people. Okay, here we go. Catherine is here. Walker, don't know why, but you're muted. If you can. Now this is Catherine Walker from the Michigan group.
Yeah, can you hear me?
Oh, I can hear you loud and clear now. Excellent.
Okay, yes, Catherine Walker, County National Bank in Jackson. I am a branch manager. Pretty much do it all, I guess. Do a lot of lending. On this topic, I'm probably about a 5. I probably know enough to be dangerous.
Okay, I love it. Know enough to be dangerous. That's great. Okay, thank you, Catherine. So in the Michigan group, we've got 2 Catherines. We've got Catherine Lee and Walker. And as I shout out your name throughout the session, I'll make sure I clarify which Catherine. Excellent. Thank you for that. Let's see. This is, let's see, we've got, let's see. Okay, Brad is with us. Brad is with us on the chat. Now let me just put that down so I can clarify. And he's from Paper City Savings Bank, Wisconsin Rapids, number 7. Excellent. We've got you down as a chat. Thank you. And then let's see. Christy and Carissa are with us, credit analyst, Investors Community Bank in Manitowoc. 8. Let's see. And this is Christy is an 8. Okay. And let's see. Carissa's also with her. Okay. This is plus. Okay. Give me just a second on this. Carissa and Christy and Carissa both chat. And then let's see, we've got one other person, and this is Alexa. And Alexa is rated a 7. She's from Wolf River Community Bank, Hortonville, Wisconsin, commercial credit analyst. Excellent. And that's Alexa. And let me just write that down as well as a chat. Okay. Excellent. Give me just a second on this so I know which one. We've got Brad in the chat, Christy and Carissa, and we've got Alexa. Okay. Excellent. Okay, so now we're
Hey,
just-
David, real quick,
Yes.
we had from Oxford Bank, we also have Jack Korth, Graham Carlisle, and Joey Holman, who they're all in the chat as well, but I don't remember if I registered specifically for them since we did that like group join or whatever. So
okay,
they're in the chat as well.
And I'm sorry, who's this? Who's this?
This is Andrew Ketron from Oxford Bank. And the 3 other people that are in here from
Whoa,
Oxford Bank.
hold on.
Go ahead.
I gotta find you. Okay. Andrew with Michigan, right?
Yes, yes.
Okay, so Andrew, go ahead. You got a few
Yep,
other
so we
people?
have 3 other people. Jack Korth, which he can give his intro.
Yep. Hello, David. So I am a commercial credit analyst as well at Oxford Bank. I would say for cash flow, I'd say about a 6 as well.
About a 6, good. Okay, and the next individual, please.
Then the next one we have is Graham Carlisle.
Hey, David, Graham Carlisle, another credit analyst at Oxford Bank. I'd probably say a 5 or a 6 as well.
Okay, great.
And then the third one is Joey Holman.
Good morning, everybody. My name is Joey Hallman. I am a commercial credit analyst at Oxford Bank, and I would rate my understanding at around a 5 or 6 as well.
Okay, great. And now we've got 2 Joys, and then we've got Joey Molino, and then we've got Joey Holman. Excellent. Okay. So Merlino and then Holman. We got 2 Catherines. This is excellent in the Michigan group. Okay, well, thank you for those. Excellent. We've got basically everyone here. And we are missing Carly from Wisconsin, and but hopefully she'll join us. Well, it's good to be with each one of you today. As was mentioned, just up front, just to highlight, today we're doing the advanced financial statement and cash flow analysis. Tomorrow, Thursday, we are doing advanced tax. And then on Friday, we're doing the advanced C&I lending in the morning primarily, and CRE lending or commercial real estate lending in the afternoon. So C&I in the morning, commercial and industrial lending, lines of credit, equipment financing primarily, and then the afternoon on Friday, the commercial real estate lending section. Now, I need to we're going to do, as you can see, and as Stephanie, our administrator, mentioned, this is going to be a live session. This mirror images as if we were all physically together, either in Lansing or in Michigan, or in, for example, in Madison, in Wisconsin. And I do provide training ground-based in both of the states, but of course with COVID and so forth, we're doing this Zoom-based, but it's live. That I emphasize, even for those people, the 3 individuals, or actually 4 individuals on in the Wisconsin group that are in the chat, it's still going to be a live session. Now, we'll also, I'll call out your name periodically throughout the session, but I also want to emphasize that we'll do class shout outs. Let's just do our first class shout out. What does that mean? That means you unmute yourselves and or in the chat, you type it in. And for those in the chat, when you respond, well, you can just keep the responses real simple, of course. But the first shout out question for the whole class, and this is, of course, for both the Michigan and the Wisconsin, from now on, is we're not going to distinguish. I will start, of course, the starting list of Michigan, and then just go right through, of course, to The Wisconsin simply, I've just got the 2 pages, but let's do an entire class shout out. Yes or no, will you be with us tomorrow in the advanced tax class? Everybody, if you
Yes.
just,
Yes.
Yes.
No.
No.
Yes.
okay,
No.
all right. And in the chat, the vast majority, yes. Okay, in the chat, we've got a yes, a no. So we've got kind of a mix, but once again, for most of us, it will be, of course, in the, we'll be together. Now, what about on Friday? Friday, we have once again primarily in the morning, the advanced CNI lending, primarily in the afternoon, the advanced commercial real estate or CRE lending. Let's do the class shout out for that one. Yes or no, will you be with us?
No.
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 Okay. Wow, that's a different crowd because I know we're going to have the class the same way with the chat. Everyone's a no in the chat. Oh, no, actually, we've got a yes. Okay, good. All right. So that kind of gives me a feel for, so primarily today, a lot of you tomorrow, and then even less on Friday, but I know we've got other people joining us on Friday. And even tomorrow we'll have other people as well. But it's good to be with each one of you. If you'll turn with me to this next page, this is a little bio on myself. As was mentioned, Stephanie gave this. I'm a business trainer, a contract CFO, and a college professor. And I'm also a former commercial lender. So I'm worked at Bank of America for about 9 years, but also worked at 2 community banks, managed a commercial lending team at one point in time, and so forth. But today I do CFO work, so I'm literally just on the opposite side. I keep adjusting that so it's a little easier there. I'm on the opposite side of the table or the desk from you, work with various small to medium-sized business owners on primarily their financing needs. Do my business training in the training area. I train not just the bankers, which is primarily on the credit side, of course. My background is a commercial lender for many years, and previous to that, even a consumer lender. But I also train the CPAs. I'm on the faculty of the California CPA Education Foundation, which is, it's the main CPA organization in the state of California, which is huge. It's the main organization for all CPAs in the entire state of California. Been on the faculty there for many, many years. Then also train the attorneys, credit managers. Credit managers are the credit professionals within a corporate setting. They underwrite the larger receivables and then they collect on the back end when some of those receivables go bad. And then I also train a few other miscellaneous groups as well, but primarily the bankers, the CPAs, attorneys, and credit managers. You'll notice at the bottom left-hand side, pardon me, of this page, page number 2, I'm based in Las Vegas, as was mentioned earlier, and lived in the Vegas market for many, many years, over 33 years, but I go all over the country training, ground-based, as much as possible. Boy, during the pandemic, it's pretty rough. It's pretty rough. I will be training ground-based this coming week in a particular area in the Midwest, not in Michigan or Wisconsin, what have you, but in another area. But it just depends on the numbers and so forth relative to COVID. So I do get out, but not nearly like it was before. Of course, there was a period for about 9 months I wasn't on the road at all, which was really unusual. Basically, webinar, Zoom, every day, if you will. Now, you'll see my email address. If you'd please highlight my email address, dlosburn@cox.net. It's a little unusual. Pardon me, instead of the more common Osborne with an ORN, it's Osborne with a URN at cox.net. So DL Osborne, my initials, last name, at cox.net. Please, please, if you have questions today, don't hesitate just stop me and say, I've got a question on that. And I'm going to be asking you questions. This is once again live interaction. But I beg of you to consider this. A week from now, a month from now, you're analyzing a financial statement. You've got a question. Maybe you've already gone to 2 other team members at your, on your lending team, if you're on the lending team. Or, maybe you've gone to your boss or whoever. And boy, you get all these different opinions, possibly. Don't hesitate, reach out to me. Now, I'm just another opinion, but I'll give you my input. Also on your cash flow analysis, the same way. Of all the topics I train on, the number one topic that I receive questions on is actually tomorrow's theme, tax return. But it's actually the cash flow analysis. Now, so today, as we get into the various cash flow models, we will emphasize primarily the financial statement as the source document. Tomorrow, we'll emphasize primarily the tax return as the source document. Now, but please, no matter what the issue is, please don't hesitate, reach out to me. Now, I train on other subjects besides even these 3 days in a row. I provide, for example, loan documentation training. Now, we don't prepare the docs. It's from the perspective of understanding the loan documents primarily from a legal perspective to protect the bank, if you will, and so forth. And several other different topics, but primarily all focused or tied into lending. So now with that, if you'll move forward with me, page number 3. Now at the top right-hand side of this page, if you'd please put this in your notes. This is a little summary of today's session. Section number 1, if you put this in your notes at the top right-hand side of page number 3, please. Pardon me. Section number 1 we're going to cover is what I call accounting review, advanced accounting concepts. So we talk about advanced financial statement analysis. Well, this first part is really more from an accounting perspective. But we're looking at and discussing the financial statements. Now you're saying, well, wait a minute, why don't we just jump right to like the key ratios or the cash flow models? Well, this first section, what I call accounting, if you will, or accounting basics, but I want to emphasize it's not just the basics. We're going to look at the basics, but then we're going to bring it to a much higher level. And we're going to tie the accounting into your role as a credit analyst, loan officer, what have you. Most of you are credit analysts. So it's understanding the underlying financial statements. I will say this straight up front. This area, in my opinion, is overlooked by a lot of commercial credit analysts and loan officers. We get in the habit. When I was on your side of the table, I did the same. I got in the habit of not having enough time. And therefore, when I got the financial statements from the borrower, from the customer, I grabbed the financials. And as long as they looked like they're halfway decent quality, I would go with it. I'd spread the numbers, or I'd have the numbers spread. Sometimes I would spread them, or have an analyst spread them, and so forth. And then I would go from there to analyze the financial statements, the cash flow modeling, the financial strength or weakness of the borrower or proposed borrower. Well, hindsight, if I would have known what I know now, I would have looked at it way differently. Now, a lot of the perspective in this first section is from the perspective of a CFO. I've served as a CFO for multiple companies. I'm a contract CFO. That means I work with multiple clients. And in the past, since transitioning, if you will, from the bank to do what I do today, I've been the CFO, contract CFO for some major clients. Had one customer a few years back, and annual revenue at one point in time, $100 million. So pretty heavy hitter, privately held though, of course, big company. But I work with primarily with small, medium-sized clients now. There are issues in the financial statements behind the scenes that you don't see as a lender, as a credit analyst. We're going to talk about those. Section number two is our traditional, what I call traditional key ratio analysis. We're going to talk about the LALOC model. LALOC, it's an acronym, LALOC, if you put that in your notes. Of course, we'll come back to that. Section number two, the basic LALOC model. Okay. The LALOC model, key ratio analysis. At the end of that LALOC model, the C, the LALOC, the C is cash flow. We'll do the three foundational cash flow models: EBITDA, personal, and global. But we'll do the basic, but then we will dissect and go way deeper than traditional. Then section number three, if you put section number three, top right-hand side of your page, we're then going to do advanced cash flow models. Addition, we will have done the foundational and then shifted to the advanced of the foundational models. But then we're going to emphasize in section three, cash basis cash flow. I think you'll find that interesting versus the EBITDA, which is traditionally accrual basis cash flow model. So in section three, cash basis, we'll also include a couple other miscellaneous models in the advanced cash flow section three. And then lastly, section number four, we're going to cover two advanced key ratio models: the Altman Z-score bankruptcy predictor and the sustainable growth model. Altman Z-score bankruptcy predictor and the sustainable growth model in section number four. I think you'll find those interesting as well. Definitely advanced models. So even though some of today's material is foundational or basic, we'll do the real quick review of the basic and then dive much deeper in each of these four areas, if you will. Okay. Now, before we continue, just a little housekeeping. As was mentioned earlier by Stephanie, our administrator, or alluded to, we will take breaks. We'll take two quick 5-minute breaks in the morning, 2 5-minute breaks in the afternoon. We'll take a half-hour lunch from now to Michigan. This is Eastern time, of course, from 9 a.m. to 9:30. Then, of course, I'm sorry, that's my time. I apologize. 9 a.m. You're going 9 a.m. 12 noon to 12:30. For the people in Wisconsin Central Time, it would be, of course, 11 a.m. to 11:30. My time, 9 a.m. to 9:30. So I'm 3 hours different than Michigan, 2 hours from Wisconsin. Because, of course, in Las Vegas, we're Pacific time. We're the same as California. A lot of people ask me, well, they get a little confused. What time is Vegas? What time are you? Well, we're Pacific. The entire state of Nevada is Pacific time. Go across the border into Arizona, and that gets a little tricky. We're the same time zone right now with Arizona, but come November, when the clocks change, time change. Arizona doesn't change. They've got enough sun, if you will. And so half the year they're essentially, for us, they're mountain time. Half the year they're Pacific time. But Nevada, we're all Pacific time. With that, let's jump right into this first section. Section number 1, the accounting. The 4 financial statements, income statement, of course. Revenue minus expense gives us net income or net loss, pretty basic. Income statement, otherwise known as the P&L or profit and loss. Statement of retained earnings or owner's equity. State balance sheet, assets equal liabilities plus owner's equity. Statement of cash flows. Now, this is one that we often, by the way, going back to statement of retained earnings, let me give you the formula there, of course, is beginning retained earnings plus net income or minus a loss, minus either a dividend or distribution, gives us ending retained earnings. Beginning retained earnings plus net income or minus a loss, minus the distribution or dividend, depending on the type of business, gives us ending retained earnings or owner's equity. Off to the side of part B, if you put this in your notes, if it's a C corp, we call it a dividend, of course. If it's an S corp or an LLC, it's a distribution. Pardon me, if it's a distribution. If it is a sole proprietorship, it's a withdrawal or draw for short. It's all the same. It's taking equity out of the business. Balance sheet, once again, assets equal liabilities plus owner's equity. Statement of cash flows, direct versus indirect method. You maybe remember this from your accounting. Indirect, we start with net income in the operating activity, and we add and subtract changes to current assets and current liabilities. Back up under D1, the direct method, we essentially take the accrual-based income statement and convert it to a cash-based. Now let's turn the page. Let's go ahead. Page number 4, just a quick review of the statement of cash flows. Sources and uses, if you will. We're going to come back to this. We're going to see this later in our UCA cash flow model. So in this session today, we actually not only go the 4 sections, but even the sections build on each other to a degree, tie in together, foundational all the way further. Here we have Simpson Company. Well, let's make believe. Who owns Simpson Company? Who owns all of the different case study companies that we're going to cover today? Bob and Sue. Bob and Sue, who are Bob and Sue? Imaginary business owners. Bob and Sue own ABC LLC. They own Simpson Company. You're going to see they own all these different businesses. The generic company is ABC LLC. Small manufacturer based where? Grand Rapids, Michigan area. Okay. Their CFO is by the name of Jane. Jane is their CFO. Oh, she's good. You love working with Jane because everything is timely, everything is accurate. Their independent CPA is by the name of George. George is their independent CPA. Okay. Well, Bob and Sue also own Simpson Company. Statement of cash flows. Look at the 3 activities. I had to highlight, grab, and boy, if you haven't done so, and oh, by the way, please, if you haven't printed out the PowerPoint presentation, I encourage you to do so. You got plenty of time to do so. Also, if you grab a highlighter, grab a pen, so you can take notes right on the forms, the hard copy. And then I encourage you, of course, to keep this in a binder. Tomorrow's class in a binder. If you're with us, not many of you on Friday, but a few of you, and then even more people joining us, I know, on Friday. Boy, the same idea. Operating activity, first of the 3 big. This is the normal sources and uses of cash from the operations of the business. They receive payment, they receive cash from customers, $10,400. Source, that's a source of cash. I put a little S next to that, to the right of the 10,400. Pardon me. Then, of course, they pay out in their normal operations for rent, cleaning, telephone, all the employees down below. Those are all uses. I put a little U next to the bracketed, the minus, the cash outlay. Second major area in this statement of cash flows, pardon me, cash flow from investing. This is the cash in and out from buying and or selling fixed assets. In this example, pretty straightforward. They purchased equipment, 1680. I put next to the 1680, which of course is bracketed. It's a use of cash. They took cash and they pay the cash out to buy the equipment. What if they sold equipment for 1680? Obviously no brackets, and it's a source of cash versus this is a use of cash. How about financing? Well, debt and equity, debt and equity, debt and equity. You can see how the company capitalizes or finances its operation. You can see investment from the stockholders, 60,000. Now, if Bob and Sue dished out the 60,000 into their business, that's of course from their personal is a use of cash, but to this business, it's a source of cash. Then of course, periodically they pay themselves a dividend, $1,200 in this example, use. So 60,000 source, 1,200 use. What if they obtained a bank loan from you, from your bank? Source of cash, but then they pay it back in the form of principal and interest, use of cash from the business perspective. Now, this is obviously a small little business. You notice, by the way, before we forget, look at the total ending cash position, 61,140. I put a little note next to that. That must balance to the cash position on the balance sheet. I would put that right next to the 61,140. That must balance to the cash position on the balance sheet. Okay, now let's bring this even further to be even more technical in our discussion. The 61,140 should balance, must balance to the cash position on the balance sheet. But it's not just the cash position technically, it is the bank reconciled cash position on the balance sheet. So it's after Jane, the CFO, has done the bank reconciliation or balanced the checkbook of the company, whatever that cash position, which is on the balance sheet, that's this number must balance to or match, if you will. So oftentimes we just say, oh, well, it's the cash position on the balance sheet. Well, it is, but it's technically the bank reconciled cash position. Okay, now let's shift this same model to a much larger company than Simpson. Pardon me, let's shift it to Walmart. Walmart, yeah, Walmart. Now, operating. Walmart will issue, they will buy inventory, billions of dollars of inventory. Use of cash, they turn right around. They sell that inventory with a markup. And that becomes a source of cash, use of cash, source of cash. Normal operations of the business. Okay. Investing. What about the second activity? Well, what about all the box stores that Walmart has? Big box stores. They owned very little of any of those. What? No, those are long-term leases. Those are long-term leases with investment groups that own those buildings. But Walmart does own their distribution centers scattered around the country. Okay, I need to ask, Jordan, have you ever seen a Walmart distribution center? Ever?
I don't think I have.
Okay. Thank you. Dwight, have you ever seen one?
Yeah, I have.
Where is it at? Can you remember what part of, is it in Michigan, Wisconsin?
Yeah, it's in Michigan, just north of Coldwater, when you travel on 69.
Okay, good. How big is the distribution center?
It's pretty huge, actually. It's got like
Okay.
trucks going in and out of it a lot.
Yeah, excellent. Thank you, Dwight. I'm going to tell you flat out, we have one an hour and a half from Vegas, from Las Vegas, Walmart distribution center. It's actually in southern Utah. It's like, what? Yeah, Utah's only an hour and a half from Vegas. Well, and California, the state line, is 35 minutes from Vegas. California is. But I mean, it's still the desert. You know, you got to take several hours to get to LA, 4 hours or so, but still. Southern Utah, if you've ever heard of Zion's National Park, one of those most popular national parks in America, right after you would exit the freeway to go up into the park, now it takes another half hour, 40 minutes, depends on the traffic, to get from the freeway up into Zion's National Park. Right in that area off the freeway is a huge Walmart distribution center. As Dwight, as you mentioned, trucks going in and out of there I've heard like literally 24/7, every minute or something like that, every 2 minutes or something. And it's huge. Let's say that distribution center cost Walmart $50 million. Okay, 50 million. Investing, use of cash all the way. Well, and then all of a sudden Walmart realizes after they build the distribution center, wait a minute, we've got an extra 5 acres on the side of the property we don't need. Why don't we sell that to a non-competitor, another type of distribution type in that location? The zoning's already there. They sell the 5 acres for 5 million or 10 million or whatever it is. That becomes, of course, the source of cash in the investing. How about financing for Walmart? Debt and equity? Well, they do have multi-billion-dollar lines of credit, usually with a consortium of banks or a syndication, if you will, basically a group of banks. Just like the major casinos in Vegas. Oh, major casinos in Vegas, it's usually a group of banks, if you will, that will finance the casino, including Bank of America, Wells Fargo, US Bank as the lead bank, Chase, all of them. Oh, Citibank, you bet. For whatever it's worth, they don't finance the hotel rooms. They just finance the casino, the true cash flow. The hotel rooms are financed with a REIT, real estate investment trust. Just happens to be attached together. Back to Walmart, they will issue on the debt side. They may have those lines of credit, but their major debt structure in their capital structure of Walmart are bonds. They'll issue $100 million in new bond offering. Well, in the financing area, that's a source of cash. $100 million comes into Walmart cash. Once every 6 months, because bonds typically pay every 6 months interest. That's a use of cash. Then at the end of the 10 or 20 or 30 year period, the principal is paid off. That's a use of cash. Oftentimes, I put in your notes, Walmart will set up, or any large corporation will set up, or even a municipality that issues a bond, or the state of Wisconsin issues a bond, or what have you. They will set up what is called a sinking fund. A sinking fund. It's kind of a weird name, but that means that the corporation Walmart or the municipality or whatever will put money, principal, into this pot, so to speak, and build up the principal. So at the end of the 10, 20, 30 years, there's enough principal to repay the bond. Just a thought. What about on the equity side? Under financing, third area, Walmart will issue $100 million in new common stock. Stockholders will buy up the stock, exchange for basically the stock certificates, the piece of paper, which today it's all virtual mainly. It's just like a bank account or brokerage account. I mean, you may get a statement, but it's mainly online. But a certificate, that's old fashioned. They will issue $100 million in new common stock. That's a source of cash to Walmart. Then once a quarter, they pay a dividend out to the shareholders. Use of cash. Once again, the ending cash position must balance to the cash position of the balance sheet. Pardon me, and specifically the bank reconciled cash position of the balance sheet. Moving right along. Now, page number 5. Page number 5, the 10-step accounting cycle. The financial statements just don't appear out of nowhere. I find this to be very true. Even a lot of business owners don't realize what goes into the 10-step accounting cycle. They just don't. And like I said, I mentioned this a moment ago. When I was on your side of the table, you get so busy. You don't think of these steps. You just think of step number 7. I need the 4 financials, or primarily of the 4 financials we've just reviewed. It's the income statement and the balance sheet that we primarily use. And we'll see that in section number 2 when we get into the Laylock model, the key ratio model. Okay. But obviously there is a lot more to this. Now, what I'm going to do, so we're just going to spend just a couple of minutes and go through the 10 steps. And then I'm going to ask you to sit back and take a couple of minutes, just a moment or so, after we go through the 10 steps, and pick out the top 2 or 3, just say 2 of these steps that you as a commercial underwriter, loan underwriter, should pay more attention to. Now, obviously, number 7 of the financial statements, that is exempt from this activity we're going to do in just a moment, because those are the financials. But of the 10 steps, besides step number 7, what are just 2 that as a credit analyst, you should be thinking, wow, maybe I should be asking Jane a few questions related to the accounting cycle. And you may be saying to yourself right now, well, why are we doing this? Well, because there is an old saying from way back, decades ago, garbage in, garbage out, GIGO for short, GIGO. If there is garbage shoved through these books going in, when you get to step number 7, what you receive is garbage. I don't mean to be mean. I don't mean to speak out of school, but garbage in, garbage out. Okay, here we go. Let's just do a quick review of the 10 steps. Then I'm going to have you do this activity. I'm going to ask several of you for your thoughts. Wow. I'm going to ask several of you for, okay, what 2 would you want? Should you ask Jane, the CFO? Bob and Sue, CFO, company, generic company. Of course, we'll see the various different case studies with different company names, but generic company we're going to use today, ABC LLC. Jane's the CFO. George, independent CPA. Okay, step number 1. Business transactions. Jane must make a decision. Bottom line. Is this a business transaction, or is this a personal transaction that's being tried to shove into the books? Is it, for example, Bob comes to her and says, oh, well, I ran here's my receipts. Or she sees the statement for the corporate credit card or business credit card. And he bought 4 new tires for his truck. But she says to herself, wait a minute, is that business or personal? Moving right along, number 2, journal entries, the debits and the credits. the journal entries. These are the daily journal entries. At the end of the account, now we're not going to do the rules of debits and credits today, but at the end of the accounting period, the end of the month, the end of the quarter, end of the year, typically the end of the month, each month, Jane will go take those journal entries and post to the ledger accounts, the like kind accounts. All the cash transactions will go into, whether the debits and credits for the period, will go into the cash ledger account. All of the accounts receivable transactions into the AR ledger, all the accounts payable into the AP ledger. Then at the end of the period, further, the ending balances of those ledger accounts under step number 4 will be transferred into this trial balance, which is a statement to make sure debits equal credits. Debits always have to equal credits. Then step number 5, adjusting entries. Jane, the CFO, at the end of the accounting period, the end of the month, she'll adjust for the usage of supplies. If they've used up supplies, if she doesn't adjust for it, the books are off. If she doesn't recognize the lowering or the decrease in the asset known as supplies and the increase of supplies expense, well, the asset is overstated and the expenses are understated. So the balance sheet and the income statement, quote unquote, are both messed up. She'll adjust for depreciation as well. Multiple adjusted entries. Then she prepares step number 6, the adjusted trial balance, which is a trial balance that includes the various adjusting entries. Step number 7, of course, the financial statements. Then step number 8, Jane will journalize the adjusting entries from back on step number 5 that oftentimes in the cycle are not actually journalized if she's using a worksheet. Step number 9, she closes the books. What are the three accounts under step number 9 that are closed? Think of this. Remember back to your accounting days. What are the three accounts that are closed out? Meaning they're not shut out, they're not thrown out, they're just zeroed out to get ready for the next accounting period. If you'll add this off to the side of number 9, revenue, expense, and dividend or distribution accounts. Revenue, expense, and distribution or distribution or dividend or distribution. Those 3 are zeroed out. They're not, we say we close them, but that doesn't, it almost alludes that we literally throw them out. No, we just zero them out to get ready for the next period, accounting period. What's the post-closing trial balance? These are the 3 accounts that live on, meaning the dollar amounts into the next period between 12/31 of 20 to 1/1 of 21 as an example. The 3 accounts that live on under step number 10, which we use to create the post-closing trial balance: assets, liabilities, and owner's equity accounts. Assets, liabilities, and owner's equity accounts. Okay, now we're going to do this quick activity. Take just a moment. That's just a quick review from an accounting perspective. What about your perspective as a credit analyst, commercial credit analyst? Most of you are. We're a loan officer, we're a branch manager, but we're focusing on primarily today the credit analyst, which most of you are. Or we can say you could be a loan officer, but you're doing the credit analysis, same idea. What 2 of these would you at least ask Jane to clarify? And this is an area, I'm going to say it straight out, I rarely did when I was on your side of the table. Maybe some of you do, but I was so busy. Oh no, just give me number 7. Step number 7, the financials. primarily the income statement, balance sheet, and we'll get our spreads and we'll do our analysis, which we're going to do more traditional in step number 2 or section number 2 today. As a CFO, I see this, I'm going to say this, I'm going to shout, I would like to shout this out to our entire industry. Behind the scenes as a CFO today, right now, there is so much risk in this process that you don't realize it until you're on the other side working in the company and you start to realize, whoa, I think back, wow, a lot of those numbers I received, they were not that accurate, or there were things that were put in those numbers that shouldn't have been, and those that ultimately ended up in the financial statements, and on and on and on. Okay, here we go. Take just one more, 1 minute more, if you would. Pardon me. What are just 2 items? Okay. Maurice, we'll start with you. Maurice, can you give us one of yours and start from the top down, if you would? So give us your first one of the 2, please. Maurice, if you're with us, you can just unmute. Okay. Andrew, are you with us?
Yep. So one of the things that I do is some of the debits and credits. I mean, it's not necessarily something that I ask for per se, but it's something that I will often walk through when I'm trying to do some of my analysis. One of the items that I might actually physically request, though, is a trial balance.
Oh, good. Excellent. A lot of credit analysts do not. Oh, no. We get number 7, financial statements. Oh, no way. Good. Excellent. Okay. Oh, wait, we've got Dwight, Maurice. Okay. Mo or Maurice, connection issues. Okay. There, that makes sense. Okay. Thank you for that update on the technology. And Andrew, thank you for your feedback. Trial balance and maybe debits and credits. Good. I like that. Charisma, what about you? What about you? If you'd unmute yourself, what of these 10 steps do you think there's risk that as a credit analyst, we should at least inquire? Probably not in front of Bob and Sue. They may not have that much of any accounting background. For example, what if Sue has a master's degree in mechanical engineering? She's the technical person behind the manufacturing process in ABC LLC. Bob's degree from college was in marketing, business marketing major. Hers was a master's in mechanical engineering, ME. Charisma, if you can unmute yourself and tell us which of these would you ask? One, just your first of your 2.
I was also going to say journal entries, debits and credits. Like it was stated, I wouldn't necessarily ask for clarification, but it'd be something that I'd kind of explore a little bit myself. Otherwise, I would probably pick adjusting entries.
Adjusting entries, good. Thank you for that. Catherine Lee, how about you? Catherine, what about you? What would be just one of your 2 that you would ask?
Sometimes I will go through and actually look at the accounts that we have on the books with us. Sometimes I found that they're doing transfers to their personal accounts. And sometimes you can find some information in those that are helpful for the lender to see before making a credit decision.
Wow, interesting. Good. So the distributions from the business to Bob and Sue, right?
Yep.
Good. Excellent. These are good. Ryan, how about you? These are actually, there's a few that I haven't thought about, or, they're like, oh, okay, interesting. This is good. Ryan, what about you?
I was the same as someone before. I would have asked for journal entries and adjusting entries just to see how they're kind of keeping track of stuff originally, and then what kind of adjustments they're making to those accounts.
Good. I like that. Okay. Joey, this is Joey Marino. Pardon me, Merlino. Go ahead,
cool.
Joey. Go ahead.
I actually think business transactions is important as well. because the CPA or maybe the CFOs are talking to CPA saying, hey, we want to look better. Maybe they could have had some kind of interesting things going on in the year. So some things maybe if it was actually business or personal could make the company look better off or worse. So I think being able to question or ask, is this really part of the business or is this really personal? How is that affecting how our statements are going to reflect at the end of the quarter, at the end of the year?
Good. I like that. Number one, business transaction. Good. Evan, how about you? How about you, Evan?
We're reviewing which ones we think are the most important, correct?
Yeah, no, ones that you would ask Jane, the CFO, just to clarify. Most likely you would not sit down with Bob and Sue on this because in our make-believe scenario, Bob's got a marketing degree, Sue's she's an ME, she's a master's in mechanical engineering. Oh, boy, no accounting, either one. Oh no, that's Jane. That's Jane. I mean, Bob had some basic accounting in his business degree, but he was a marketing major. Nothing wrong with that. But they're going to say, oh no, that's Jane. That's the CFO. What would be just one? And it could be the same as something that's already been mentioned.
Well, I think number 9 is important. The closing entries, especially when it comes to how long it takes for the company to close the books.
Okay, good. Oh, that's good. Timing. Oh, I'd write that down. Everybody, I'd write that down. If Jane is as good as I mentioned before, oh, she's closing, they're closing, her and her team, they're closing the books. Now, this is a small manufacturer right in the Grand Rapids, Michigan area, as I mentioned. And pardon me, they've got about 30, 35 employees, and it's not that big of an operation, but I mean, it takes time to close the books. But if she's as efficient as I'm alluded to earlier, that's pretty timely versus stretched out. That's a very, very good point, Evan. Very good point. Because you'll find there's a general correlation. Boy, if it takes them forever to close the books, they're spending a lot of extra cleanup that they should have been doing during the year. Excellent. Catherine Walker, any other comments on this one? What's your one of your two?
Well, I'm kind of with everybody else. The number 2, the journal entries, the debits and credits.
Okay. All right. Thank you. Jeremy, how about you?
I have to agree with business transactions. You mentioned the garbage in, garbage out, and if the items being reflected in the financials don't even reflect the business itself, I mean, I don't think you can get much more garbage in than that.
Okay. Good. Excellent. Now, these are my picks. And this is top to bottom. So this is not in particular any priority, but just going top to bottom. Number 1 business transaction, as was just mentioned, where Jeremy just mentioned this, and several of you did. That is one I would clarify with Jane, the CFO. I would say, without offending, we do not want, and I put a little note off to the side, if you would, somewhere, maybe the top right-hand side of the page. No double L. What's the double L? Lender liability. The double L. We don't want to come across like we're controlling this business, or we're trying to control even their accounting cycle, their books, if you will. But that doesn't mean we can't say to Jane, we just like to clarify, the internal, because we recognize the financial statements are simply a reflection of this whole process, the accounting cycle. Typically, there may be some business or some personal transactions that float through the business. Do you typically, if they do you basically journalize those off as distributions to Bob or to Sue or whoever? For example, the tires on the truck. Now, those may be legitimate business expenses because the truck's owned by the business. He uses the truck in the business. Absolutely, but it may not be. Maybe a little gray area as well. Moving right along. My second pick would be adjusting entries number 5. Major, no. The worst thing I have seen as a CFO internally are financial statements where I know the adjusting entries under step number 5 are not done timely, and I admit this, I'm submitting the package to the lender with the interim statement, knowing that all the adjusting entries are not done. Now, please, no one in our class, whether you're from in Wisconsin or Michigan, please don't throw stones at me. Don't throw stones at me right now for saying this, but we get busy. Everybody gets busy. As the CFO, I say, well, I'll work with the controller, and I'll say, well, did you do the adjusted interest? Oh, most of them. I had a client once a few years ago, the CFO, I was the CFO, the controller, and I'd work with, and whenever I questioned her on the adjusting entries, well, I did most of them. I said, well, wait a minute, we got to do all of these. Well, and this is where it came out, is that and we're going to talk about this on Friday morning in the CNI lending section, we're going to look at the BBC, the borrowing base certificate. Okay, let's do a quick class shout out. Everybody in our entire class, yes or no, do you use or touch BBCs right now? Yes or no, everybody, if you shout out, including in the chat. Yes or no?
Yes.
Okay. Whoa, in the chat as well, several in the chat. Good, excellent. Well, the BBCs in an advanced BBC, the way you look at it is not just like a basic BBC, borrowing base certificate, but in advance, you're looking at the general ledger, the financial statement, and the actual accounts receivable account balance. And those three have to balance. And in an advanced BBC, the general ledger GL, the financial statement, and the AR account with the receivables, those have to balance. Well, I had this controller, and we worked together for several years, and every once in a while she'd give me the info and it wouldn't be in balance. And she would and she'd say, well, that's okay. The bank doesn't need that. Now, we're only off by 35,000. I said, no. I said, what is this? Well, it's just, and she said exactly like several of you said, going back to number 2, the journal entries. She says, oh, well, all I have to do is just do an adjusting entry, and I just haven't gotten to it, but they don't need that. And I'd say, yeah, we want, because I wanted to be like Jane. Jane's my hero. I'm just teasing. Jane's a fictitious person. ABC LLC is Bob and Sue are, George is, and all of them. But I'd say to myself, Sal, I don't want to send a BBC to the bank where it's clear that our books are off, that there's that the numbers, that there's a variance. In actual the form, it's called a variance. So she'd go and do the journal entry. She'd come back 5 minutes later and it's cleaned up. I said, now when we submit, it's going to be all balanced. By the way, if I didn't push, that would permeate throughout our accounting in the company. And going back to number 5, the adjusting entries, what would happen in the end? Those adjusting entries would be saved up for the end of the year. And I put off to the right of number 5. Pardon me. And some of you alluded to this. A couple of you alluded to this on number 5. Timing is everything. If your borrower is not making those adjusting entries, the controller or the CFO, those interim financial statements are, just to say it bluntly, they're pathetic. They are way inaccurate, but they don't have to be. As a lender, as a former lender, and as a CFO today, a lot of times we'd say, well, those interim statements, we can't really hang our hat on it. We can't really rely upon it. But I've had clients, both sides of the table, as a CFO and as a former lender, where, boy, those adjusting entries are timely, accurate. And those interim statements, by the time you compare basically the general trend of the company to the year end, there's no surprise. It's not like all of a sudden you get the year end CPA compiled, CPA reviewed, or even an audited statement, and it's a dramatic change because the CFO or controller has kept up with the adjusting entries. They don't wait to the end of the year. Add this to your notes off to the right of number 5 as well. I'm just going to say it. The gloves are coming off right now. The gloves are coming off. I'm going to say it straight out. And I'm sure many of you figured this out. If they wait to do their adjusting entries to the end of the year, they wait. Much of that adjusting entry procedure or process is guesswork. The CFO or controller is just guessing because so much time has lapsed, so much time has gone by that they're going like, well, I don't really remember, because how do I know this? Because I've had in my CFO clients, they'll have the controllers come to me and I'll say, okay, well, you're doing the adjusted entries. Well, what's this? Well, that happened, and it's January of the next year. Well, that happened last January. It's a year ago. Well, did you do that adjusted entry? No, we didn't do it, but we're doing it right now for year end 12/31. And you talk to the controller or the CFO. And I work with clients that even have a CFO, and I'm a CFO, but they bring me in to work in a different angle, primarily in the financing, as I mentioned. Well, interact with the banks and other lenders, negotiate the deals. Well, and to help them with this, those adjusting entries, oh, a lot of guesswork. It's just made up. Now, I'm going to say this straight out as well. I put in your notes, what about George the CPA? Now, I would never say this when I train the CPAs. So please don't say this to anyone, especially if you're in the state of Michigan. Why? Well, because I also train the CPAs in the state of Michigan. I really do. In fact, I've got a couple of sessions coming up just in the next month or two. Well, CPAs would do a lot of guesswork as well. They'll just say, well, we don't know what happened on this. We'll just kind of make an educated guess, do the adjusting entry, and away you go. Much of it is a timing issue because it was not done timely before. Moving right along, let's go down. My third pick is number 9. Some of you pick number 9. Journalize the closing entries. When they close the books, they zero out the revenue accounts, the expense, and the dividend or distribution accounts. A lot of it comes back to the timing and the accuracy of this work. This process has got to be clean. It's not going to be perfect. Even in an audited financial statement, this is not going to be perfect, but it can be clean. Moving right along. Let's turn forward to page number 6. Now, we're going to start into page number 6, then we're going to take our first break of the morning in just a moment. Okay. Income statement. As I mentioned, we're going to do, of course, we're diving deeper. This is in our accounting section. Just some things to consider. In the income statement, of course, revenue and expense recognition. Accrual based. Most of the financial statements, of course, that you're working with are accrual based. We recognize what's accrual based. We recognize the revenue in the period in which it is earned. We recognize the expense in the period in which it is incurred, irregardless if cash is coming to the business or leaving the business. What's cash basis? We only recognize the cash, or we only recognize the revenue when the cash comes to the business. We only recognize the expense when the cash leaves the business. Most of your financial reporting from your borrowers or proposed borrowers, accrual-based financial statements. But I'm going to say this straight out. We're going to talk about this later in our cash flow section. Because most of your financial reporting is accrual based, there is a somewhat of an inflated numbers in the EBITDA cash flow because of accrual based versus cash basis. We'll come back to that in our cash flow areas. We've got part of number 2, and then number 3 is our cash basis, as I mentioned earlier, sections of today's presentation. What about inventory costing? We cost out FIFO, first in, first out, LIFO, last in, first out. You remember this in your accounting. What is FIFO? Well, the company buys their equipment in January and they sell it in January, February, March. FIFO, first in, first out. When they buy the inventory, they sell it, we cost it out. It flows with the normal flow of the purchase and sale, purchase and sale, purchase and sale of the inventory throughout the year. What about LIFO, last in, first out? No. We assign the cost under LIFO of the inventory that was purchased in December as if we assign that cost as if it was sold in January. What? It's simply a play off on the order of the costing out the inventory. Once again, last in December, the cost of the December purchased inventory as if it's the first inventory sold in January. Now, physically it's not, but it's just assigning the cost. If inventory cost rises throughout the accounting period from January all the way to December, and if we're costing out that higher priced inventory, our cost of goods sold will increase. Our gross profit will decrease. Our net profit will decrease, and our payment to the IRS will decrease, meaning the tax bill. Okay, now, I'd put this in your notes. From a collateral standpoint, as a lender, consider this. If you have a borrower that's using FIFO, okay, fine. That's the normal, and that's the majority of companies out there. But there are some that are using LIFO. If they're using LIFO from a collateral standpoint, using inventory as collateral, you actually may have some hidden equity in the inventory. What? What do you mean by that? Well, if they're artificially, if price of inventory is rising from January to December, and they're costing out the inventory using the cost of December as if it's January inventory, and then basically last in, first out, they're essentially artificially increasing the cost of the goods sold, the inventory, lowering the gross profit, lowering the net profit. Well, but the inventory itself, that balance is less. Well, there may be some hidden equity in the inventory if they're using the LIFO system. Jack, does that make sense? Does that make sense what I just said? You can unmute and just tell us. I know you're with the Oxford.
Yes.
Okay.
Yes, that does make sense.
You bet. So I just put that in your notes. Thank you. Okay, now what about part C? Part C. Operating expense versus improvement. Okay, we're going to do a quick class shout out. Everybody, unmute yourselves and in the chat, yes or no. Does your bank do cash out refi on commercial buildings? Yes or no?
Yes.
Yes, indeed.
Yeah.
Everybody, shout out. Everybody in the chat as well. Excellent. In the chat, yes, yes, yes. Everyone. Christy in the chat, everybody. Everybody, good. Okay, now, how does George, the CPA, how does he account for that repair? Or does he capitalize the repair? Whoa, wait a minute. Let's just say, I'll put this under part C if you would, please. Let's just say that the company, ABC LLC, they own their building. Bob and Sue say to Jane, hey, and let's say we've already got the loan on the building. We've had it, we financed it, 3 years ago or 5 years ago when they bought the building. And it was a used building. It wasn't brand new, it was used and whatever. And all of a sudden now there's some repair roof that needs to be done to the roof. and a few other items on the building. And it's about 200,000. So Bob and Sue approached Jane, the CFO. Hey, check with your lender. Check with your lender. We go to the bank. Can you see? Hey, we would like, and they're not going to most likely use the word cash out refi, but Jane will approach you, the CFO, and say, well, we'd like to refinance the building. I know the loan to value you mentioned originally max is 80% more. I think we're down to about, per my calculation, about 72%, 200,000. We'd probably bring it up to about 79, 80 at the most. No problem. You process the request. You refinance the building. You give them the cash out. Depending on the relationship, depending on the circumstance, you may literally just give them the 200,000, or you may monitor it a little bit. Okay. That's from your end of the bank. What about their end? Ultimately, now Jane will do this on the books, but ultimately, as it gets to the tax return, tomorrow's theme under Part C, will George, the CPA, consider this an expense as a repair and write off the entire 200,000 in 1 year, in one shot? Or will he capitalize it, which means he adds the 200,000 to the basis of the building and it's part of the depreciation, which, by the way, is traditionally per maker's modified accelerated cost recovery system is 39 years. Whoa. And we're going to talk about a strategy tomorrow that will have that legitimately. Tomorrow, not only will we look at cash flow, we'll look at the cash flow components, but our real major theme tomorrow is tax strategy for the small to medium-sized business borrower at your bank. So you understand it better and can interact with that Bob and Sue even better, and Jay. Okay. Okay, let me ask Graham. Graham, can you tell us, unmute yourself? Do you think George would just have the company write off the 200,000 as an expense through their income statement? Or do you think he'll capitalize it and add it to the basis of the property? And then that 200,000 gets depreciated out over a 39-year period. Graham, what would you guess he would do? Meaning George, ultimately the CPA.
I think George would probably capitalize it.
He'd capitalize it. Okay. Joey, thank you. Joey Holman, what would you say? What would you say? Do you think he'd capitalize, or do you think he would have the company write it off? Because Jane's going to talk to him. Bob and Sue are going to talk to Jane. Jane then talks to George. What would you say?
I would have to agree with Graham. Capitalize it.
Okay. All right. Matthew, what about you? What about you? What would you say?
I feel like capitalizing it would be the accurate thing to do. So
okay,
that's what he'd do.
Okay, good. So you all say capitalize. Well, I'm going to say it straight out. It depends on the CPA. The 200,000 is a small enough dollar amount, and that George could easily, in my personal opinion, he could justify as an expense. Oh, that's just a repair to the roof and some other repairs to the building. Absolutely. I work with CPAs right now, not only those that I train, but those that I work with in the Vegas market. And I've trained the CPAs in Las Vegas as well, but those that I work with more, not on the training side, but the more CFO side. There are some, no doubt about it, it's going to be capitalized, the more conservative. But there are some, no doubt about it. I know for a fact when I negotiate with those CPAs on behalf of my clients, pardon me, Part C, they will write that 200,000 off in a heartbeat, which from a tax standpoint is great. It just depends. There is more gray area in the world of the CPA than you would ever imagine. And that's negotiable. I used to work with the CPA years ago, and he's passed away years ago, but since then. But I used to negotiate with him, and he was very conservative. You know, you'd think, oh, he's going to capitalize, but every once in a while he would surprise you. And all of a sudden he would say, in this example, part C, in this illustration, part C, oh, let's just write that off. He was like, what? I'm thinking his name was Mike. I'm thinking, that's not Mike. Did Mike just say that? Or he'd email me or text me, oh, let's just write it off. Okay. He was like, what? I went and find him as the CFO. What is the goal of the CFO of Jane and George, ultimately the CPA, from a tax perspective? Lower that tax bill legitimately. Okay, with that, let's go ahead and stop right there. Let's take a 5-minute stretch break. We'll come on back, take our first break, and then we'll continue forward. So everyone, what I do is, please, I keep the system up. And then, of course, most of you are already muted, just keep it muted. But I would keep the system up on your computer. It's much easier. And then we'll come back in 5 minutes. Thank you, everyone. Excellent participation, excellent comments. Talk to you in 5 minutes. Welcome back, everyone. We'll take just a moment and we'll get started. Pardon me. Welcome back.
David, while everyone's getting back, can I ask you a quick question on that last point?
You bet. And who's this?
Jeremy, sorry.
Jeremy, go ahead, Jeremy.
I'm just wondering, you've seen situations where they handle that differently on the financial statements versus the tax returns. Like, I can't remember if there's a legal requirement to do it the same on the both, but I would think the incentive would be to capitalize on the financial statements and that they might be a little overstated in that case.
Yes, very good comment. Very, very good comment. Sometimes you will see difference on the tax return. They would take the write-off. The financial statement, they would not. They would capitalize. And so there is a difference. Tomorrow, we're going to look at Schedule M1 on the tax return for the business, right below the balance sheet, where we reconcile actually the difference between the net income on the books of the financial statement and the tax return itself. We'll talk about, but very good point. Sometimes the accountant will play it one way on the tax return, another way on the financial statement. Very good point. Good. Excellent. You bet. Well, let's come on back. We'll go ahead and we'll continue forward. Hannah, are you with us? Just want to have you do our sound check. Make sure everybody's come on back. Hannah, are you back with us?
I'm with you.
Okay, great. Well, thank you for that. Now let's move forward. Depreciation. Per the books, you remember from your accounting days, straight line, units of activity or production, and double declining balance. Let's say we have a delivery van, the business ABC LLC does. Well, typically depreciation is over a 5-year period for the books for the delivery van. If it's a $20,000 asset, assuming, quote unquote, assuming no salvage value or residual value of the delivery van on the back end, we would take the 20,000 divided by 5 or 4,000 per year, straight line. Units of production or activity is based upon the miles driven. You know, it's calculated 50 cents per mile is the depreciation. Double declining balance is 2 times the straight line. So if you have a 5-year depreciation on the asset, on that vehicle, then it's 20% each year. So the double declining is simply 2 times 20 or 40%. Now that's on the book side, which is our major emphasis today. But there is the tax side, which is our major emphasis tomorrow. Although you'll see tomorrow where major emphasis is tax, but we'll talk a little book as well, kind of the flip side. The two classes, of course, merge together. If you look with me, makers, modified accelerated cost recovery system. I mentioned that earlier. Now on that building, it is a 39-year depreciation, but legitimate strategy we talk about tomorrow that will have that to about 20-21 years. Modified accelerated cost recovery system for the vehicle that we talked about in D1 up above is typically a 5-year depreciation. Non-cash expenditure, typically. What about Section 179? Section 179, of course, if we're using the tax return as the basis for our cash flow analysis, leading once again, this whole foundational Section 1 will give us the foundation to go to Section 2, 3, and 4. Well, Section 179 on the tax on Form 4562, which is where the makers is as well. Section 179 allows your borrower from the tax standpoint to write off possibly the entire piece of equipment or asset in 1 year. If you'd add this right below Section 179, please. In this year we're in now, 2021, right now, per the tax code, your borrower can buy up to, let me rephrase that, they can write off up to $1,050,000 in one shot, up to $1,050,000 in equipment purchases. Write that off for depreciation, Section 179. in 1 year, with the stipulation that they don't purchase more than, it's a little over 2.6 million, a little over $2.6 million. Okay, now, what if Bob and Sue's company, ABC LLC, the manufacturer, what if they purchased $750,000 worth of equipment? Well, they could write it all off in one shot because it's below the $1,050,000. And if that's the only equipment they buy, well, that's not even close to the little over $2.6 million. But when they work through Jane or with Jane, Bob and Sue do, and George, the CPA, Jane is the CFO, advises Bob and Sue, and she even advises George that, hey, wait a minute. We may not want to exercise our right or use Section 179. We may not want to do that because why? Well, we're writing it all off and we're getting a huge tax deduction. But you've got to show enough money, enough cash flow, enough income / cash flow to qualify for the loan. If Jane, as a good CFO, she knows this, that, hey, wait a minute, the company is growing. She says to Bob and Sue, we're going to be on a growth path, it looks like, for the next 3 years or so. We need to show enough income, enough cash flow to qualify with Heather, with your bank, to qualify for the loan, cash flow. Now, there is an old saying, and I would put this off to the side. This is from a strategy standpoint from your borrower. They want to show enough income to qualify for the loan, but not so much that they pay through the nose to the IRS. They've got to show enough income to qualify for the new loan, but not so much that they pay through the nose to the IRS. So if the company knows it's good, if Bob and Sue and Jane, boy, they've strategized, well, the next 3 years, it's going to be a growth pattern and we need finance. We need the bank to stand behind us. Jane needs to advise them, well, even though all these tax write-offs are here, including Section 179, maybe we don't exercise that. We take that piece of equipment, that $750,000 new piece of equipment to be used in the manufacturing process. And let's say they're in Grand Rapids, but let's say they're opening another location, another manufacturing location in Wausau, Wisconsin. Wausau, of course. I've been in Wausau, absolutely. I've been in Grand Rapids too. Yeah. So now, she says, well, so why don't we take that piece of equipment and instead of doing Section 179, we do makers, 5 year. Oh, okay. But let's say there's not a growth pattern. They're not going to expand from Grand Rapids over to Wausau. They're not going to open a new location. So there's 2 manufacturing plants. No, well, then they do the Section 179. Now that's from their strategy. Okay, let me ask this. Does your bank add back for cash flow purposes? We're jumping forward to cash flow. We're laying that foundation. Does your bank add back makers? Most everyone does. But what about Section 179? Depreciation. Okay, Brad, I'm going to ask you, Christy and Carissa, I know you're all 3 in the chat. If you would please just type in Brad, Christy, and Carissa, if you would. Okay, here they come. They're already responding. I love this. Okay, here we go. Brad says, yes, they do add it back in. Christy says, yes, they do add it back in. Okay, thank you for that. Okay, now everybody, if you'll add this to your notes, please. Approximately, from a cash flow perspective, approximately 60% of all commercial lenders today in America, nationwide, do not add back Section 179 in our cash flow modeling. What? 40% do, 60% no, 40% yes. This is a controversy in our industry, has been for decades and decades. Why would 60% approximately not add it back in? Well, they play it more conservative. What do you mean? Well, look at it this way. When your customer, Bob and Sue, ABC LLC, when ABC LLC, when they pay for fuel, they're dishing out the cash and they're writing off the fuel expense. When they pay the salaries, they dish out the cash and they pay and they recognize the expense, the salary expense. Well, wait a minute. When they buy that piece of equipment for $750,000, which is below the limit of $1.05 million, as long as they don't purchase more than 2.6 million, but the limit is $1.05 million. Well, wait a minute. The conservative commercial underwriter today says, well, they dished out the cash. They write off the asset and they dished out the cash. Well, wait a minute. We don't add back fuel expense. We don't add back salary expense. So why would we add this back? Oh, that's the 60%, the more conservative. Now, Brad, Christy, Carissa, you all add it back in. Here's the arguments. Here are two arguments for the 40% people, which are all of you, Brad, Christy, and Carissa. I'd add these to your notes, everyone. First argument, no particular order, first argument. Whose cash was it? Whose cash was it to buy that piece of equipment? Well, most of that cash came in the form of a bank loan. The bank loan. Most of you finance 80 to 90% LTV, loan to value. So the vast majority of the cash came from where? The bank loan. So why don't we add it back in, meaning Section 179? Here's the second argument for adding it back in to the cash flow. Second argument is this. What if ABC LLC, the borrower, only purchases new equipment every 5, 6, or 7 years? Only every 5, 6, or 7 years. It's called a non-recurring event. 5, 6, or 7 years. It's non-recurring. It's non-recurring. Well, we don't want it. We add it back in. It's a kind of unusual situation. The slang term is we throw them a bone. That means we add it back in to benefit the cash flow. What about 100% bonus? We'll see this tomorrow as well. We'll keep it light today, just brief. It's called special depreciation or 100%. It's aggressive. I put in your notes, most all lenders do not add it back in, and I would not. It's too aggressive. Too aggressive. We'll come back to that tomorrow. Now let's go back to Section 179 for just a second. In Section 179, no matter what your bank does, no matter if your bank adds it back in or doesn't today, my recommendation is, and I would put this in your notes further back on Section 179, no matter what your bank does, be consistent. All lenders do the same. I worked in a bank. We had 4 commercial lending centers sprinkled around or geographically positioned around the metro area. 4 of them. We had about 3 or 4 lenders in each center and a couple of support staff people. So 4 different teams, same bank. 3 of the teams did not add back Section 179, believe it or not. 3 of the teams did not. One of them, 3 of them, the teams played it conservative. One of them added it back in. And everyone questioned the team leader of that 4th team. And he goes, I don't care what you guys do. We're making loans on my team. And I know if we add back section 179 just consistently, our cash flow model is going to be higher. Our cash flow analysis is going to be stronger. We're going to get more deals approved. He didn't mix words. He told everybody. Senior management even knew it. Bizarre. You go to loan committee. You'd have a loan officer from each of the 4 lending teams. Everybody knew the fourth lender that presented at loan committee downtown, same bank, same management. Everybody knew that 4th person had an advantage over the rest of us. Why? Because they were adding back section 179. Just a thought. Questions on this? James, any questions on this? Depreciation, either D1 on the book or D2 on the tax. Any questions, James?
Nope, I'm good.
Good, excellent, thank you. Now let's go down to amortization depletion. Well, on the books or the tax, but we're emphasizing more on the books today. Amortization is like depreciation, but of course for an intangible asset. Trademark, logo, goodwill, we add it back in, non-cash. Depletion, like depreciation, but of course for a natural resource. Timber, oil, natural gas, coal, add it back in. Essentially, all lenders add back under Part E, amortization, depletion. Moving right along. Let's continue. Now for the balance sheet. Accounts receivable. Okay, off to the side of accounts receivable, and we're going to talk about this further on Friday morning in the CNI section, lending. But let's just say it straight out here, right to the right of receivables. Pardon me, in that little blank spot on the top right side of the page, if you'd please add this to your notes. Your borrower is a lender. What? Just put in your notes. Our borrower, our bank borrowers are lenders. Our bank borrowers are lenders. What? No, we're the lender. ABC LLC, based in Grand Rapids, and now they've expanded to Wausau. Okay, so they've got 2 locations. And geographically for the upper Midwest, it made sense to do that, distribution-wise and so forth. They're a lender. What? No, we're their lender. They're not a lender. Oh, yeah, they are. As soon as they give terms and create an accounts receivable, they become a lender. So I beg of you, further on the top right-hand side of this page, if you would please put this in your notes, please. We need to assist, or pardon me, we need to scrutinize or we need to look at their ability as a lender. Now you see that on that little footnote there, or that little A2 off to the side, assessing your customer's ability as a lender. We need to scrutinize them or look at them more and more as a lender. What? We don't usually do this. But when we look at the ARs, the receivables, including the agings, including, I'd add next to agings the BBC. Many of you work with the borrowing-based certificates. In your mind, please think of ABC LLC as a lender. We lend to them. They manufacture the product. They have supplies coming in from their suppliers, raw material. They manufacture. It's a light manufacturer. It's not heavy industry, light. And then they ship it out, but they give their terms. They give 30, 45, 60-day terms to their clients. They become a lender. How good of a lender are they? I would have a sit down. My recommendation, I put this in your notes further in the top right-hand side of this page. I would have a sit down with Jane and say, Jane, okay, we lend to you. You lend to your customers in the form of receivables. Yeah, she'll look at you. Yeah, I agree. Okay, we obviously underwrite you. Jane, how do you underwrite your clients? And that's the key to this. Now, unfortunately, a lot of the CFOs will look at you and they'll go, and she may even say, oh, this is off the record. But we work with some of these clients, and Bob and Sue just walk in my office and say, we've been together for 20 years, or we've known this guy for 15 years, just give him credit. What's the limit? Oh, it doesn't matter what it is, 100,000, 200,000, we don't care. Okay. Yes, sir. Yes, ma'am. I mean, it's done. That's no underwriting. And she even says, oh, I pushed to get financial statements, and they look at me like, are you kidding me? We've been doing business for 20 years. But Jane is good. Remember, she's sharp. You love working with her because she has at least convinced Bob and Sue that any new clients that they lend to, oh yeah, provide credit to, it's lending, that they require, if the receivable is more than say 50,000 or whatever, or more than 100,000, we want financial statements. And she is starting to do some of the analysis we do and will do later in our session in the laylock model. You want to hear that, not just to hear it, but to realize that Jane realizes there's risk in those receivables. And the underlying risk is, how good of a lender is she? How good of a lender are they, meaning ABC LLC? Just a thought. Moving right along, look at part B. Talking about receivables. Do most of your clients, your borrowers, use the allowance method? No way. Most of your borrowers use the direct charge-off or write-off method. What does that mean under part B? That means, and this happens all the time, that means they wait until George contacts Jane and says, it's time to write off this particular receivable. Wow. There's risk in this to you as a lender, because what are you doing? You're lending to the lender. And if they're charging off, well, it's just like a bank charge off, same idea. But they're charging off their loan. We don't want them to charge off their loans. We want them to be a better underwriter up front. Direct charge off, direct write off is the standard. Well, if you have a larger borrower, more sophisticated, they will use the allowance method. But I've even seen some CFO clients of mine, big companies, you'd be surprised. They still use the direct charge off or write off method. They wait till the CPA insists and says, it's time to charge this off, this receivable. In the allowance method, which is essentially what your bank uses, because your bank does what is called the loan loss, or has a loan loss reserve, of course. Officially today, it's called an ALLL, Allowance for Loan and Lease Loss, ALLL. Look at the two methods from the accounting perspective. Percentage of sales. Well, Jane reserves, if she's using the more sophisticated, what does she do? Well, we charge off about 1% of our credit sales. So that's what we'll reserve. Very basic, very simple math. What about percentage of receivables? Well, percentage of receivables is more the aging. This is more based off, of course, the AR aging, which is similar to what we look at in our BBC. So if she's using the percentage of receivables, essentially she's doing a BBC, borrowing-based certificate, on herself. I mean, or on their own business. She's reserving a little bit for 0 to 30 day, 31 to 60 more, 61 to 90, even more reserve, and over 90, even more reserve. Same idea. What about on the payable side, down below under part C? We want our clients, and we're going to see this in one of our key ratios in the laylock model, just a few minutes. We want our clients to be more effective in their cash flow, their true cash flow analysis. We want them to stretch out their payables. It's the timing. I put that in your notes. We want them to stretch out those payables, but not too much. That's where the COD comes into play. Okay, Alexa, if you can type into the chat, any idea what is COD? What is COD? Any idea? What does that stand for? If you'll type into the chat, please. Alexa, what does COD stand for? Okay, any idea? Zach, how about you? Any idea what is COD? If you'd unmute and tell us, do you have any idea what COD is? It's okay if you don't know, but do you have an idea what COD is? Angela, how about you? Angela, can you unmute and can you tell us, do you know what COD is?
Cash on delivery.
Oh, you are right on. Cash on delivery or cash on demand, same thing. Good. Cash on demand, cash on delivery. Excellent. Thank you, Angela. Good. Now, what is that? Well, it's where the company, they push too far out. They delay their payments on the payables too far out. And then they get cut off by the trade, by their trade. Because the truth of the matter is they may have a line of credit with you, with your bank, but they also have credit facilities with their suppliers. Oh, the suppliers extend them credit. 50,000, 100,000, 500,000, $1 million. Oh, absolutely. Now, most of these are not, they're not a formal promissory note like we have on our line of credit. They're more trade. They're in the trade, if you will. But you don't want to get put on COD or cash on demand, cash on delivery. It doesn't mean your borrowers should not push those payables. Absolutely. But not too far. Moving right along, part D, capital versus operating lease on the balance sheet. If you'll add this to your notes, if you have an operating lease, like the company rents a backhoe for a week. Yesterday, I'm driving down the road and I saw this truck and it said we provide backhoe service, rent by the day. Just yesterday, I saw this. Well, they rented by the day or they rented it for a week. That's operating expense. It's just an expense through they just expense it off. Well, but what about capital? This is where they finance the purchase of that equipment through the capital lease. Technically, the company doesn't own the equipment. The bank or other lender owns the equipment till they make the last payment. But it shows up on the balance sheet. And I'd also add this underneath part D. There is some off-balance sheet financing that are in the form of capital leases. They don't show up on the balance sheet. I'd add this to your notes further. In the accounting profession, there has been a push for several years in order to, if it's a reviewed or audited financial statement, if it's a reviewed or audited financial statement, there is a major push to start disclosing more so that those off-balance sheet financing arrangements, those leases, are not off balance sheet. I mean, they're not, they may not be on the balance sheet, but they show up in the notes to the financial statements or the notes to the financial statements. Absolutely. That's a big push. Moving right along. Moving forward. Let's turn page number 8. The last part, balance sheet. The equity section. If it's a C Corp, you could have common versus preferred stock. What are the two major benefits of holding the preferred stock, which are usually the founders of the C Corp? Oftentimes, they're awarded the preferred stock. First benefit, dividends. There's only so much cash to go around to pay dividends. They get paid the dividends first, then the common shareholders. Number 2 benefit, the second benefit, if the company liquidates, the preferred shareholders get paid first, then the common. What about S Corp? Common, there's only common stock. How about the LLC partnership? The most common borrowing entity we have, we call it capital, the equity. Now, just a few little miscellaneous related concepts when we move forward. Treasury stock. Treasury stock. What is it? Well, Microsoft will buy $500 million worth of its own stock in the open market. $500 million. And then they will take that stock and hold it for 6 months. And with the anticipation that the overall general market of the stock or value or price of the stock will rise. And then they will sell that stock out in the open market. They're making a position on their own stock. It almost sounds like illegal or insider type transaction, but it's legal and acceptable. Where does the word treasury come from? Well, 100 years ago, they would do this, but it would be actual physical certificates, stock certificates, which you don't really see much today. I mean, you could maybe have one, but unusual. And then what the company would do is buy those physical certificates, the piece of paper, and put them in their treasury or their vault to store. What's a stock split? 2 for 1? Shareholder, you're the shareholder. You have 1 share worth $10. You get a notice from the company. Oh, we're going to do a 2 for 1 stock split. What do you mean by that? 2 for 1. Well, now you have 2 shares worth $5 a piece. You still have $10. Why would a publicly traded corporation do this? I put off to the side or underneath Part B. The reason why they do this is because the stock split gets momentum in the stock, the escalation. They time the stock splits, usually the company will, publicly traded corporation will, to be done in conjunction with or near positive public announcements for the company, so that the stock splits and splits and splits and splits. And what happens is that shareholder now has 2 shares worth $5 a piece, but overnight they're both worth $10. Whoa. And then they do another split, and they do another split. What about retained earnings? I put this in your notes, restrictions on retained earnings. Now, big publicly traded corporations, as part of their bond offering, like we talked about Walmart with their bond, they may have certain restrictions on their retained earnings, meaning they can't pay out too much of it. But what are they really doing? By restricting the retained earnings, they're restricting the access to the company's cash. They can't say we're going to restrict the cash. So they restrict the retained earnings to a certain amount. And what's the flip side on the balance sheet? The cash. They can't pay out. Now you say, well, I don't bank big publicly traded corporations. I bank mainly small to medium-sized businesses. But I would add this to your notes under Part C further. Many of you do bank nonprofits that are smaller businesses in your market, a nonprofit. And those nonprofits will have restrictions on their retained earnings. So they can't pay out that much cash. They don't pay out dividends, so they don't pay out that, but they it's to control their cash ultimately. Okay, Jordan, let me ask you this. Do you deal with any way, shape, or form with nonprofits in your bank? Do you have any nonprofit organizations that you bank?
Yeah, we do.
Okay, great. Excellent. Dwight, how about you? Do you deal with any nonprofits? I know Dwight had some technical difficulty earlier, but do you have any nonprofits?
Yes, sir.
Okay, we're back. Excellent. Good. Good. Excellent. Let's move forward. Now, page number 9. Quality of the financial statements. We talked about the 4 types, of course. The quality. Okay. We have, of course, the top rung is the audit. But look down below under Part B. Let's start with B3, company prepared. Then we're going to go compiled, reviewed, and then back up to audit. But before we do so, Maurice, do you want me to call you Maurice or Mo? What would you rather me call you?
Mo's great.
Mo, okay, Mo. Let me ask the question, Mo. What's your typical reporting from your typical commercial borrower at your bank, in your department, not your bank overall, but your department? What's your typical reporting?
We just get tax returns usually.
Not even the company prepared?
We'll get company prepares if they're not, if it's in the middle of the year.
Okay, interim
but
period,
yeah.
but you rely mainly on the tax return, okay.
Yep.
Now, why do you do it? The reason why, Mo, why do you do that, Mo? Why not push for these financial statements?
A lot of times we don't like to pass that cost on to the customer if it's not necessary.
Okay, that's good. That's a good point. Now, here's another point is company prepared oftentimes are not that accurate. Would you agree with me, Mo?
Yes, I would definitely agree.
You bet. Whereas the tax return, we say to ourselves, well, boy, if George is signing off on that tax return, we can hang our hat a little better on that form of source document versus a company prepared source document for the numbers. Okay, good. Pardon me, Andrew, let me ask you, in your world, what type of reporting do you see? Is it mainly tax returns, or on the financial statement, what level do you typically get, Andrew?
We get tax returns as well. We'll get year-end company prepareds if we're in the first, maybe second quarter.
Okay.
And if those tax returns aren't complete, and then same thing that Mo said, we'll get them on an interim basis as well.
Good, excellent. Charisma, what about you? Charisma, what level of reporting does your bank do typically within your world?
We typically get tax returns. We will also get financial statements. I prefer to work off the tax returns.
Good. What level of financial statements do you look at typically when you get those? Is it
We do get company prepared, but quite a few of our businesses have audited financial statements.
Really?
Yeah.
Interesting. What, no names mentioned, what types of business, what type of industry with the audited?
Some hospitals.
Yep.
And then, what's the other one? I just talked to someone about one the other day and I can't think of who it was, but yeah, I know primarily the hospitals that we work with.
Good. The reason why hospitals is a lot of times the requirements for Medicare, Medicaid is you, hospital, will have a fully audited financial statement. Absolutely. Good. Excellent. Thank you for that. Now, let's go to the very bottom. Company prepared. QuickBooks. Off to the right of that, under B3, I'd put in your notes, QuickBooks, if you would, please. Now, QuickBooks. Sometimes credit analysts and loan officers, I find, make this mistake. When they get the company prepared financial statements, pardon me, they bash QuickBooks. Say, oh, I hate these QuickBook financial statements. The balance sheets don't balance. They're just messed up. Well, I would add this to your notes, everyone off to the side of B3. QuickBooks is state-of-the-art software. QuickBooks is top of the line. Essentially, all CPAs in America are in tune with QuickBooks. It is the standard in America. The mistake that I find with some, not all, but a few credit analysts and a few loan officers is they should not bash the software. It is the individual or individuals using the software, known as QuickBooks. That's the culprit. So when we work with Jane, the Janes of the world, we should say to Jane, okay, interim statement, it's a QuickBook prepared, company prepared. Of course, we get those annual financial or annual tax returns. We may even get annual company prepared, or maybe even an annual CPA compiled under B2 up above, or even a review. But we should still sit down and say, hey, wait a minute. Okay, especially with the company prepared, we should say, Jane, you prepare them. How accurate do you think these are? Or some way, without offending her, without getting into where we're controlling the books, we don't want to even get close to the double L, lender liability. She says, well, I think they're pretty accurate. And a lot of this depends on your interaction with the Janes of the world, depends on the relationship, of course, you built with them, the way you can talk with them, just candidly or not. Compiled. CPA compiled. Pardon me, the CPA basically takes the QuickBooks from the company, slaps it into George, slaps it into his format, puts a big disclaimer, says this is information, this is from management, you're done. But most CPAs will not put that information in the compile without at least looking at it, making a few corrections. What about reviewed? Reviewed is a different level, reviewed. Catherine Lee, do you ever see reviewed financial statements? Do you ever see reviewed, Catherine?
Yeah, we see reviewed statements.
Okay, it's quite a bit. Well, what is this? Well, George, the CPA, will go out to the business, to ABC LLC, and he'll camp out for sometimes a week in their conference room and review the books. What is he reviewing the books? Per GAAP, generally accepted accounting principles, GAAP. Absolutely. So, Catherine, do you see a lot or just a few in a given year on the review?
Probably just a few in a given year. It
Okay.
might depend on what the lender wants to put on when we do the loan.
Gotcha. The requirement, the reporting requirement. Good. Okay, thank you for that. Thank you. Now let's jump to audit, the very top. Right next to audit to the right, I put in your notes. What does George do for the audit? Oh, way more extensive. And this is why it's more expensive, which was kind of alluded to. Well, we don't want to put that burden on the client. Well, I agree with not putting burden on them, but depending on the size of the credit relationship with your bank, traditionally, most banks, boy, company prepared and the tax return, up to maybe $500,000, $750,000, maybe even $1 million. Boy, once you get much above $1 million, $1.5 million, we want to compile. You get close to 2 million, we want reviewed. You get over 2 million or over 3 million, or whatever the breaking point is. Every bank's a little different, every market's a little different. We want a full audit. Audits are expensive because it's a lot of work. Off to the side of audit, put in your notes, please, review the books per GAAP, GAAP. Number one. Number two, George will send out confirmation letters to the banks, not just your bank, but if they have another bank, to another bank, confirming all deposit and all loan relationships. All deposits and loan relationships. Number three, George will send out a confirmation letter to the AR and AP of the company as of 12/31 of 20. We're coming up 12/31 of 21. As of this date, did they owe you so much? Did you owe them so much? On the receivable, did you owe them $50,000? On the payable, did they owe you $50,000? If there's too many receivables, too many payables, the CPA will do a sampling. Here's the next confirmation, the last one. The CPA will send out a confirmation letter, to the company's attorney. First question in that letter will be, is there any legal issues? Is there any legal issue, or are there any legal issues impacting or facing the company? Yes or no? No, boom, done. If it's yes, the letter clearly states, attorney at law, you must tell us, in your legal opinion, could this issue in a material way negatively impact this company, ABC LLC? Some attorneys don't want to sign those letters because they're putting their necks on the line, especially in a full audit, especially when it's not $1 million or $2 million credit facility. It's $4 or $5 million or $6 million. Oh, and they know that. Wow. 4 levels of an audit. Unqualified, off to the right, it's the only level that we as a bank would accept. Off to the right of unqualified, I'd put the word clean. It's not perfect, but it's clean. No violations of GAAP. The books are clean. It's the only one we traditionally would accept. What about number 2, qualified? 1 or 2 or 3 violations of GAAP. 1 or 2 or 3 violations of GAAP. Level 3, the adverse, multiple violations of GAAP. I put in your notes, please. Multiple violations. Disclaimer. I put the word run. You get a disclaimer, you run the other way. The books are so messed up, the CPA cannot and will not render an opinion. Now, the most common, of course, is unqualified. Why? Well, George gets out there and he sees a few errors. He works with Jane to clean up the errors, and then he issues a clean, unqualified audit. I've seen, though, I've only seen in my career maybe once or twice adverse or disclaimer. And believe it or not, as was mentioned a moment ago, it was a hospital. The hospital per Medicare, per Medicaid, had to have an audited financial statement. But this was a county hospital, and not to speak out of school, it was so financially messed up. It was just horrendous. So they had an audit, but it wasn't a level 1 or 2, it was either a 3 or a 4. It was horrendous. Happens. It happens, unfortunately. Okay. Moving right along, look at the notes. We mentioned the notes earlier. Typically, this would be with the reviewed or audited statement. The notes clarified the various parts of the financial statements. I would put under part C, I would not hesitate to ask George, the CPA. I don't understand note number 5. I don't understand note number 8. I don't understand note number 13. Can you clarify those for me? Absolutely. Moving right along. By the way, the notes are usually written in legalese. Of course, you've seen that. Many of you have seen those. Some of you haven't. What do you mean legalese? Well, the wording sometimes is prepared by the attorney, or the CPA will use certain phraseology that's tough, very tough. Now, I don't mean to speak out of school, but I'll have CPAs contact me. And they know they're preparing an audited statement that's going to be used to obtain, to apply for sizable finance. 4, 5, 6 million, pretty good size for a small, medium-sized company, medium size. I'll have CPAs contact me and say, hey, you're a former banker, you train the bankers, you work with them. Hey, can you help me with my notes? Oh yeah, no problem. Email them to me and I kind of clean up the notes, send them right back to the CPA. Well, then what happens? A month later, I look at the final product, I'm going, boy, this verbiage looks really familiar. Well, why? Because I created it. Now that's all off the record, of course, but the CPA will reach out to me. Why? Because he says, I want to word it so that the banker understands, so it's in their language, our language. Because the CPA's language and our language it overlaps some, but it's definitely not the same. Any questions on this page? Questions, Ryan, any questions for us on this page at all?
Nope, I think I'm good.
Good, excellent, thank you. Let's roll forward. Page number 10 now. We're going to go into now our second section today, the key ratio, including the Laylock model. Okay, but before we do so, let's go ahead, take our second break of the morning. Let's take another 5-minute stretch break. We'll come on back and we'll roll forward into section number 2. Talk to you in 5 minutes, everyone. Thank you. Excellent participation once again. We'll just keep it rolling. Thank you. Welcome back, everyone. We'll take just a moment and we'll get started. Take just a moment. Okay, Joey Molino, are you back with us? Can you do our sound check, please?
Yep, can you hear me?
Oh, clearly. Excellent. Thank you for
Awesome.
doing that. Always like to do the sound check with Zoom and just to make sure we can hear each other and so forth. Welcome back now, section number 2. Section number 2 is our key ratio analysis, understanding the numbers even further. It's the laylock model we'll see in just a moment. Before we do so, this introduction section of number 2 or part 2, creditor, investor, management, and guarantor. Who uses this discipline that we're working on today? We've looked at the accounting, we reviewed that, and some risk areas that we oftentimes don't look at or consider as commercial lenders. Now we've got the financial statements. We're going to quote unquote assume that they're relatively accurate. Now, look at the creditor, bank loan officer, bond rating analyst. You're the loan officer, you're the credit analyst, or the bond rating analyst. That's the individual that looks at those bonds we talked about, like the Walmart bond or the bond issued by the city of Green Bay or the city of Marquette or whatever. Now, cash flow analysis, you can see the emphasis. Can they pay back the loan to the bank? Can they pay back the bond? Can the city of Marquette, Michigan, can the city of Green Bay, Wisconsin? Look at investor. Stock analysts will look at the numbers a little differently, but they also will focus on cash flow to a degree. I put off to the side of number 2 there, that second category, investor. When you have a small to medium-sized business, privately held, that sells, what is the math, the major mathematical equation to determine the value or the sales price? It is a multiple of EBITDA. I put that in your notes, please. EBITDA, which we'll cover in a moment. It's a multiple of EBITDA. Okay. All right, let me ask Evan. Evan, have you ever had a bank client that sells out to another company? Could sell out to a competitor, could sell out to even a big nationwide conglomerate.
That's that one comes back. Yeah, sorry, I have. Sorry, we're still experiencing some of those difficulties.
Okay, no problem. So Evan, you've seen that, right? Customers will sell out, is that right?
Correct.
You bet. Well, how do they determine the price? If it's a large publicly traded corporation, it's usually a multiple of book value, the book value of the equity of the business. Okay, for the balance sheet, it's a multiple, 1 times, 2 times, 3 times book value. But in a small to medium-sized privately held firm, it's usually a multiple of annual EBITDA or cash flow. So, for example, you have a client, annual revenue of $1 million, just to keep the math simple. Today, some of the multiples are 2 or 3 times, maybe even 4, depending on the industry, depending on the business. Let's say it's 3 times EBITDA, multiple annual, and the annual is $1 million. What's the value? What's the cost? 1 million times 3, or $3 million. It's pretty simple on the math. It's a multiple of annual EBITDA. Back in 2004 to 2007, before the crash, before the Great Recession of 08, 09 into 2010, there were a lot of businesses, believe it or not, that were selling for 5 and 6 times EBITDA. All of a sudden, the Great Recession hit 08, 09. If you could even find a buyer, the multiple of cash flow to sell the business was 50%. So if it was $1 million, it went from possibly 5 or 6 million down to only 500,000 overnight. Why? Because of the Great Recession. And plus, well, who has the money to buy? Let's go to number 3. Business owners and manager. Business owners, right above business owners, if you'd put the letter P. Right above manager, if you put managers, if you put the letter A. The letter P stands for principals. The principals of the business, Bob and Sue. The letter A, the agent. The manager, in this case, Jane, the CFO. She's their agent. Do they always agree with on the cash flow analysis internally? No. And by the way, give you a little hint, a lot of your clients, they have a cash flow meeting once a week internally. Oh, absolutely. Bob and Sue and Jane, this is common for the owners and the senior management and the CFO to have a meeting once a week to review the receivables, which are their loans, and to review the payment of those receivables and any other issues impacting the cash flow of the business. Believe it or not, not all businesses, not all of your borrowers do this, but a lot do. Bob and Sue may agree together, but they may disagree with Jane, the manager, the agent, her interpretation of a certain aspect or certain issue that's impacting the firm's cash flow. The next week, it could be Sue and Jane agree versus Bob, or Bob and Jane versus Sue. That's common. Just like you and your team leader may not agree on certain interpretation of the numbers, the financial statements. You may not agree with credit administration. They may not agree with you. Same idea. Let's go to number 4. The guarantor. I put Bob and Sue right next to business owners. We're going to look at the related analysis because of the concept that ultimately we're going to do the combined or global cash flow. Global cash flow has only been required for about the last less than 5 years in our industry. Years and years ago was optional. But today the federal bank examiners, they want to see the combined. Well, why do we do the business owner? Is because most of you are banking small to medium-sized privately held firms. And if you don't tie the business owner with the business, you essentially miss half the story of the cash flow. If you put in your notes right below this 4th category, guarantor, this is a legal phrase. It is called the alter ego theory. It's a legal phrase, alter ego theory. Well, what is alter ego theory? The business and the business owner are essentially alter egos of each other. They're literally one and the same. Alter ego theory, that's what this is. Okay. Catherine Walker, I need to ask, does your bank bank any big publicly traded corporations at all? Was it all small to medium-sized businesses?
Generally, it's just small to medium size. I don't recall any of the more larger ones like you're thinking of, like I get the Walmarts or anything like that.
Got it. Okay, good. All right, thank you. Jeremy, how about in your world? Do you underwrite any publicly traded corporations, or are they all small to medium-sized business borrowers?
All small to medium.
Got it. Okay. Thank you. Good. Let's move forward. Page number 11. Now, page number 11. Whoa, jumped over that. This is the laylock model. The 5-step laylock model. Liquidity all the way down to cash. Now, please, if you grab your pen or highlighter and circle the first letter of each of these, please. L for liquidity, A for activity, L for leverage, O for operating performance, C for cash flow. Okay. Now, once again, we have to do that first major section, the accounting, to make sure our underlying reporting is accurate as much as possible. But now we take these numbers and we quote unquote assume, well, we can rely on these numbers. We do the laylock model. Off to the right, pardon me, the right of liquidity, if you please put in your notes the definition of liquidity. The company's ability to service its short-term obligations, less than 12 months. The company's ability to service short-term obligations, less than 12 months. Here's another way to define liquidity: the nearest to cash, cash all the way. How about activity? Pardon me, activity is defined as follows: the turn factors or swing factors. Turn factors or swing factors. Whoa, what's this? We're going to talk about AR, AP, and inventory turnover. Accounts receivable, accounts payable, and inventory turnover. Turn factors, swing factors. They swing up, they swing down. They turn up, they turn down. Third category, leverage, defined as follows: the company's ability to service its long-term obligations, more than 12 months. Think even in terms of, like 3, 4, 5 years out. More than 12 months, but think even longer out. Letter D, operating performance, defined as the profitability of the business. Now, that can be a profit or a loss. The profitability of the business. Is the business profitable? Is it in a loss mode? And lastly, part E, cash flow. Cash in versus cash out. Cash in versus cash out. Another way to describe or define cash flow, 2 words: lifeblood. Financially speaking, the lifeblood of the business is its cash flow. Would you agree with me, Jack? Would you agree with me on that? The lifeblood of the business, financially speaking, is cash flow.
I would agree with you on that one.
You bet. Okay, now, another way to define it is, of course, cash in versus cash out, or lifeblood. Same with the household, financially speaking. So it's the cash flow. Absolutely. Okay, now what we're going to do before we move forward and look at our case study in this area, what I'd like everyone to do is, to the left of liquidity, you see part A, pardon me, to the left of liquidity, and just one little notch up above that, if you would please put in your notes short term. So to the left of part A and one line up, if you put short term. Now this is less than a year. I'm going to have you prioritize by number, the 5-step laylock model. The first, number 1, if you go all the way down right next to letter E to the left, put a number 1. Cash flow is number 1. Now remember, we're talking short term, less than 12 months. What would be the second priority? Remember, it's short term. What would be the third? What would be the fourth? And what would be the 5th priority? The hint is, number 1 is cash flow. So you put a number 1 to the left of part E. But what would be number 2? What would be number 3, number 4, number 5? Take a couple of minutes on this. Just take a moment or so. We'll come back. But take a moment, think about this. Now, a few of you, we've got a couple of groups. We've got a couple of groups that, boy, don't hesitate. Don't hesitate. We've got a couple of groups, both in Michigan and Wisconsin. So don't hesitate. If you're with other people, you can talk, of course. What would you say is number 2, number 3, number 4, and number 5 in priority? And the hint is short term. We start with cash flow as number 1. What's number 2, 3, 4, and 5? Take just a moment more on this. I'll ask a few of you your thoughts. What numbers did you put down? Pardon me. Take just a moment more on this. What would your number 2 be, number 3, 4, and number 5? Okay, Graham, number 1 is cash flow. Remember, we're talking short term, less than a year. What would your number 2 be? What would you put for number 2?
We talked about putting operating performance as number 2.
Okay, operating performance. Thank you. Joey Holman, what would you say is number 2, short term?
I would say number 2 would be liquidity.
Liquidity. Thank you. Matthew, what would you say is number 2? What would you say is number 2?
I'd also say liquidity would be number 2.
Liquidity. Liquidity is correct. Number 1 is cash flow. Number 2, liquidity. Not operating performance. That's a bigger picture, long term. We're talking short term. Hannah, what did you put for number 3? What did you put for number 3?
I was thinking operating performance.
Okay. Okay. All right. Heather, what about number 3 for you?
I was thinking activity.
Activity is correct. Activity is number 3. Cash flow, number 1. Number 2, liquidity. Number 3, activity. Absolutely. What about, James? What about number 4? What would you say is number 4?
I'm going to go with leverage here for number 4.
Okay. Number 4, leverage. Zach, what about number 4?
I was thinking operating performance.
Operating performance is correct. Number 4 is operating performance. Number 5 is leverage. Okay. Number 5 is leverage. Now, we start with cash flow, liquidity, activity, operating performance, leverage. Okay. Now you consider it's, remember the hint, it was less than a year. Okay, now let's prioritize the model. Let's, for long-term, over to the far right of liquidity, past your notes of the definition, and then just one line up way over on the far right. If you put long-term, and think in terms of even 3, 4, 5 years out, long-term perspective. Okay, let me give you the hint. Number 1 is still cash flow. I put that in your notes. So right to the right of cash flow, way over to the right in that column, to the far right, up above, you put long-term, pardon me, 3, 4, 5 years out. Down below, number 1 is still cash flow. What about number 2, number 3, number 4, number 5? And the hint is, this is long-term, big picture, long-term, big picture. What would be number 2? Think in terms of the overall business. What would be number 2, number 3, number 4, number 5? Take just a moment on this. And I'm going to ask Brad and Christy and Carissa, Brad, Christy, and Carissa in the chat. If you will type those in, you can just type them in quickly. Once you get that, you'll type that into the chat. Tell us your thoughts. How would you prioritize the laylock model? Long-term, big picture, long-term, overall company. Number 1 is cash flow. What would be number 2, 3, 4, and 5? And the hint is, of course, it's a totally different order than short-term. After we leave cash flow, number 1. So if you go ahead, type that in when you can. We'll even also, Alexa, will have you join in as well in the chat, if you wouldn't mind, if you'll tell us your thoughts, please. What's number 2? What's number 3, number 4, and number 5? Take just a moment on this, if you would, please. Just take a stab at it. Number 1 is cash flow. What's number 2, 3, 4, and 5? Okay, they're starting to come in. They're starting to come in on the chat. Excellent. We'll wait just another moment. Everybody, if you'll write those down, if you're with other people, several of you have a group of people, and we've got about 2 or 3 groups. And boy, yeah, go ahead. Don't hesitate. Talk to the people on your team. Okay. Take just another moment or so. Okay, here we go. Let's do, okay, this is Brad. Brad says, number 2 is operating performance. Number 3 is leverage. Number 4, activity. Number 5, liquidity. Christy says, number 2, number 1's cash flow, of course. Number 2, long-term operating performance. Number 3, activity. Number 4, leverage. Number 5, liquidity. Okay. In my opinion, number 1's cash flow. Number 2 is operating performance. Big picture. If they don't reach profitability, eventually they're going to wither. They're going to die. Number 3, I personally believe, is leverage. Number 4, activity. Number 5, liquidity. Cash flow, operating performance, leverage, activity, liquidity, in that order. Good. Now, could you argue a different order, both whether we're talking short-term or long-term? Oh, absolutely. Oh, absolutely. You could argue. You could, especially if you applied this model specifically to a particular borrower. Oh, absolutely. Now, before we move forward, why do we have the laylock model in this order? This does not mirror image, pardon me, either short-term or long-term. Well, it's the traditional order. Most banks will use this order. I saw a bank more recently that they switched activity and leverage the position, B and C, and they swapped those 2, but pretty much the same order. Number 1 thought. Number 2, by far the average bank in America, in the financial analysis section of the write-up, the loan write-up, the credit memorandum, based off the financial statement, no matter which way you put the order, cash flow is traditionally the last, because it's like the crescendo of the analysis, if you will. Let's move forward to page number 12. Page number 12, our next case study. This is Snyder Corporation. Bob and Sue own this. This business is based in Marquette, Michigan, in the UP. Okay, it's a manufacturer. So they got a manufacturing operation in Grand Rapids, Michigan, Wausau. Now we've added to the story. And even though they're the same Bob and Sue, this is Snyder Corp up in Marquette area. This is 18, 19, 20. These are actual numbers, not in thousands. These are actual. I'd like everyone to spend just a moment. Page number 12, page number 13. Look at the income, look at the balance sheets, look at the income statements and the industry comparisons down below on page number 13 at the bottom. Pardon me. Take just a moment. Review the financial statements. Take a moment. Then I'm going to point out some kind of interesting twists to the numbers. And then we're also I'm going to have you highlight some of the industry comparisons that we'll use right after our lunch break. Okay, so take just a moment. Review page 12 and page 13, if you would please. Pardon me. Page number 12, page number 13. Okay, let's go to the balance sheet, page number 12, pretty straightforward. Current assets, long-term assets, current liabilities, long-term liabilities, equity section of the balance sheet. I'd just point out a couple items. If you'll notice, Look at the common stock at the bottom left-hand side of the page. And then if you go over to the right, you'll see the 460,000, 460, and 1,680,000 and change. Well, wait a minute. What did Bob and Sue do? They sold off part of the business. How much cash did they raise? About 1.2 million, you can see. About 1.2 million. Now, did they go public? No. Did they do an IPO, initial public offering? No. They did what's called a private placement and just sold part of the business, local, to local businessmen and women. How much did they sell? 49%. Why? Well, because they realized if we keep 51% or more, we control the business. By the way, they probably violated your loan covenant. What's your loan covenant? Well, one of your loan covenants standard in the business loan agreement, if you use Laser Pro. Okay, let's do a class shout out. Everybody, open up the mics, unmute yourselves, and in the chat. Do you use Laser Pro for your loan documentation? Yes or no?
Yes.
Yes.
No.
Yes.
I don't know.
Brad says yes. Christy says yes from the chat. Okay. Laser Pro is the dominant, but there's Arta, there's Compliance One, there's other platforms. But in business loan agreement, standard verbiage. You sell off part of that business without our approval, violation of the loan covenant. We can call the note. We can call that line of credit or that note. Absolutely. The negative is they violated that. They didn't tell us. The positive is look what they did with the cash. Look at the long-term debt. They brought it from $1 million down to 500,000. If you go up to the notes payable from 720,000 down to 300. Okay. Turn the page forward to page number 13. Look at the income statements. Of course, you all noticed. Look at the loss for the middle of the year. It was a rough year. Rough year. This is before COVID. Well, they bid on some of the projects wrong up at in their plant in Marquette. Wow. Look at 2020. How did that happen? That's the pandemic. The operation in Marquette, Michigan, in the UP, in the UP there is a plastics manufacturer. So when COVID hit, all of the the plastic that you see, the barriers you see, I saw one just the other day, the plexiglass, if you will, everywhere, including your bank lobby. Oh, they made a killing in that time period. Now they realize, there's a saturation point plus what happens, as the pandemic wanes and so forth. Well, they've already geared up for that, but that's why, look at that. Look at that profitability. Okay, under the industry comparison, have you highlight current ratio and the 2.7 to the right, please. Quick and the 1.0 to the right. Inventory turnover and the 6.1 to the right. Days sales outstanding, which is the same thing as AR turnover, and 32 days to the right. And then lastly, the debt ratio, a couple notches down, debt ratio, and the 2.0 to the right. We're going to use these right after the lunch break. Let's go ahead and turn to page number 14. We'll stop right there and take our half-hour lunch. Before we do so, please, I recommend just keep the system up and then it's easy just to come on back. Have a good lunch, everyone. Talk to you in 30 minutes. Thank you. Thank you so much. Sound check for us. Would you do our sound check for us, please, Angela? Are you back with us? Give everyone just another moment or so, and we'll get started. Oh, great. Thank you so much. Thank you. Okay, before we get started, any questions you've thought of during the break, during the lunch break? Do you have any questions at all? Anyone? Okay. All right. Let's go ahead and proceed then. Our 5-step laylock model. Now, for the sake of time, I'm going to give you, quote unquote, the answers. And you just write these down, because I recognize most of you spread the numbers. You do this on a regular basis. So we'll spend just a few minutes on this. The more important aspect is to not only obviously the number generation, but more importantly for today's class, the interpretation. Are we interpreting the numbers correctly? We're quote unquote assuming that the underlying financial statement now is correct. It's clean. It's, it's maybe not 100% accurate, but it's clean. And we've done our calculations correctly. And then we're going to interpret. So for working capital, let me have you write these down. This is for 18, 19, and 20, and then IND for industry. You can just write these. You can write that at the top of this, and we'll apply to all 3 of these calculations. Okay. In 2018, for Snyder Corporation, the working capital was $642,400. $642,400. And just to save the time, instead of having you manually calculate these, $642,400 for the first year. For 19, the working capital, which of course you can see the formula, current assets minus current liabilities, $617,842. Pardon me, $617,842. For the third year, $1,640,312. $1,640,312. The current ratio, current assets divided by current liabilities, the first year, 2.33. 2.33 for the first year. The second year, 1.46. 1.46. The third year, 2020, 2.58. 2.58. Now, what about the quicker asset test ratio? You can see current assets minus inventory divided by current liabilities. Why do we chop out the inventory? Traditionally, the least liquid of the current assets. The first year, 18, 0.85, 0.85. The second year, 0.50, 0.50. And the third year, 0.93, 0.93. Okay, now, industry, we saw back on the previous page. We saw that right before the break. You could see there on page number 13, the current ratio, the 2.7, the quicker asset test, 1.0. So on page number 14, working capital at NA not available because it's a raw number. But under the current ratio for the industry, the 2.7 and the quick is a 1.0. You just put those in your notes, put those right in the form, please. Now, before we do our assessment, let me give you an old-fashioned rule of thumb current ratio. The old-fashioned rule of thumb is a minimum of 2.0, which means if you have a current ratio of 2.0 or higher, in theory, you have strong liquidity. The old-fashioned rule of thumb for the quicker asset test ratio is 1.0, 1.0. Just happens to be match the industry standard for this particular company for Snyder Corp. Now, what is more important than the old-fashioned rules of thumb? At the top right-hand side of this page, if you'd please add this to your notes. 2 rules of thumb, 2 general rules of thumb in looking at all of the key ratios. Number 1, self to self. Number 2, self to industry. What do you mean by self to self? Well, the company relative to itself, meaning the trend, year-end 18, 19, and 20. Rule number 2, self to industry. We compare our numbers to the industry standards. Some of these key ratios we have industry standards, some we don't. We'll see this as the model continues to unfold. We saw it even right here. What is one major source of industry comparison? RMA, or Risk Management Association. A lot of commercial lenders use it. Okay, let's do a quick class shout out. Everybody, if you unmute yourself, and in the chat, if you would say yes or no. Does your bank use, or do you use, the RMA studies? Yes, or no? Okay, we've got a yes. We've got some no's. We've got yeses. Okay. All right. Christy says yes. Brad says no. Okay. Let's see. We've got, all right. Alexa, she says yes, and so forth. Thank you for that. Excellent. Okay. A lot of you do, some of you don't. And there's other industry comparisons. Okay, now what I'd like to have you do, everybody do this, and I'll ask a few of you your opinion. Strong, moderate, or weak. Overall, Snyder Corporation's liquidity, this first of the 5-step laylock model. Remember, the basic calculation is basic, but now we're taking it to a higher level. How would you interpret this company's liquidity? Strong, moderate, or weak? Now look at self to self, the trend line, 18, 19, 20, rule number 1. Number 2, if there are 2 of these 3, there is an industry standard, self to industry. By the way, on each one of these, when I say strong, moderate, or weak, you can even hedge a little bit. You could say weak to moderate, moderate to weak, moderate to strong, strong to moderate. Everyone take just a moment on this first model, liquidity for Snyder Corp. How would you rate the company's liquidity? Strong, moderate, or weak, or we'll hedge in between? Take just a moment more. Okay, here we go. Jordan, what would you say? Jordan, what would you say?
For 2020, I'd say liquidity was decently strong.
Oh, wait, let's back up. Overall, big picture, the self to self, the self to industry, overall statement. What would you say this company's liquidity? How would you peg this liquidity?
Overall, I'd say moderate.
Moderate. Okay, no hedge. Moderate to weak, weak to no moderate to strong, just a solid moderate.
Yeah, I'll slap it in moderate right now.
Okay, thank you. Dwight, how about you? What's your overall assessment? What would you say, Dwight? Dwight, what would you say?
I would agree with moderate.
Moderate, okay. Mo, how about you? What would you say?
I'm also in agreement with moderate.
Moderate, okay, excellent. Thank you for that. Okay, now let's look at the related. Bring this even to a higher level. So we do the basic, higher level, and even higher level. We talked about true cash. We talked about accrual versus cash basis earlier today in our accounting section. Well, that could play someone off of this as well, timing wise. I would put off to the side of number 1. George, the CPA, can swing those numbers on an accrual-based financial statement. It can adjust these numbers depending on fiscal year number 1, fiscal year number 2. Certain adjusting entries can take place, which could shift all of these numbers. Look at number 2 down below. To bring these numbers even to a higher level, look at prepaid expenses. What do you mean by prepaid? Remember prepaid rent, prepaid insurance, as an example. Per GAAP, general accepted accounting principles, those are current assets. But ask yourself, will that prepaid rent or prepaid insurance ever convert to cash? And the answer is traditionally no. So I put a little note next to prepaid expenses. If you see prepaid expenses on the current assets, which by per GAAP, they are current assets, I would take them out. If you're spreading the numbers, I would drop them down below the line, take them out of current assets into other assets. That will make working capital current ratio and quicker asset tests much more conservative. Absolutely. Okay, while we're on that topic, do you ever see prepaid expenses? Andrew, do we ever see those? Do you ever see those typically in most of your analysis? Do you see those on the balance sheets?
Most of them, no, but I do see them fairly often.
Okay, you do see them. Good, good, thank you. So once again, to be more conservative, drop it down below. Take it out of the current assets. You violate GAAP by doing it. But as commercial lenders, we believe in GAAP, but we don't believe in GAAP. It's a strange world we're in. We believe in GAAP, even in our business loan agreement in Laser Pro. We want the financial statements per GAAP, but in certain parts of our analysis, we violate GAAP, which we just did. Here's another violation. Due from officers, shareholders, and employees. It's a current asset by definition. Well, but wait a minute. Do Bob and Sue really pay themselves back? Or I'm sorry, do they really pay the company back? Because this is an asset on the company's books because Bob and Sue have borrowed from their company. It's due from, not to, but from officers, shareholders. No, we own the company. We're not going to pay ourselves back. It's not cash. Drop it down below the line. How about due from employees? Employees will borrow from their employer. Happens all the time. Well, in the form of a payroll advance. And then payday comes, oh, I don't have the money. Can you just put it on my tab? Well, why would we? It's an asset, a current asset on the balance sheet for your borrower. But why would we chop it out? Well, because these type of receivables have a high percentage or likelihood of default. We don't want, no, adjust this. Make these numbers more conservative, more real. Look at number 3 down below. Related to Bob and Sue. Remember we talked about tying the two together? Not just in the cash flow, but several of these other models. The alter ego theory, we talked about the legal concept. Well, under number 3, I would not hesitate to ask Bob, Sue, Jane, do you have any contingent liability? You're sitting there with Bob and Sue and Jane. This does happen, unfortunately. All of a sudden, out of the blue, Bob and Sue kind of sheepishly look at you and they look at Jane and Jane doesn't even know. They invested $100,000 into this real estate project, okay? A separate real estate project. And they never even told Jane. Now, well, they justified it because, well, that was personal. But most CFOs of most privately held firms, they know the personal financial condition of the owners, the principals. They have to because of the tie between the two. It's not like a big publicly traded corporation. All of a sudden, they sheepishly say, well, yeah, we do have some contingent liability. And Jane's looking at you just stunned. She's looking at you, you're looking at her like, what's this? Well, we were invited to invest in this $5 million deal, and we put $100,000 in. And then, of course, the natural question would be from you. Or you may say, well, not me, I'm the credit analyst. I don't really interact with Bob and Sue. That's the loan officer. Well, fine, the loan officer should get this information to you. She gets this info. And so the loan officer says, well, what is this? Well, we invested, but they made us sign personal guarantees for the whole $5 million. What? Could you imagine that? Jane is like stunned. She is just frozen in time, like, what? It happens. It happens more than you would think. Okay, I'm going to ask the question. A shout out, a class shout out. Please do not mention names or specific circumstances. Have any of us in our class today, have any of us ever experienced something like that where, unbeknownst to us, but we find out, pardon me, Bob and Sue have guaranteed some sizable debt, and possibly the CFO doesn't even know? Just a shout out, please, someone just, if you've ever seen that happen in your career, have you ever seen it or heard it within your bank? No names, don't mention the name of the company, of course, or the principals, but have you ever heard or seen that? Anyone?
Yes.
Yes.
Okay, we've got some yeses. Anyone else? Wow, we've got a few yeses. Wow. Okay, for those two individuals that shouted out yes, well, let's see, we've got a chat also. We've got a no in the chat, but those two people that said yeses, how large was the contingent liability roughly? Do you know? How large was it?
Not offhand, no.
Okay, no.
It was pretty large though.
Pretty large though, you know,
Zero.
multi-million or whatever. Yeah, and that does happen. Contingent liability is huge. Thank you for that. Let's turn forward. Model number 2 of our 5-step model, the activity. Okay. We said earlier, how did we define it? The turn factors, the swing factors, pardon me. Now we've got AR turn, AP, and inventory turnover. You can see the formula for AR divided by sales times days in the period. If it's an annual financial statement, times 365. If it's semi-annual, 180, 182. AP turnover, AP divided by cost of goods sold, or COGS for short, times days in the period. Inventory turnover, inventory divided by COGS times days in the period. COGS, COGS, cost of goods sold. Okay, let me give you the numbers just to, for the sake of time. Let me have you plug in at the top, put in the top of this page, right above accounts receivable turnover there, 18, 19, 20, and I&D for industry. And then we can just fill in the numbers. Okay. Here we go. AR turnover, and these are rounded days. These are rounded. The first period, 2018, 38 days. AR for the second period, rounded, 40 days. Okay, 40 days. The third period, 46 days. 38, 40, 46. What's the industry standard? Days sales outstanding, which is day AR turnover, back on page 13. 32 days. Put 32 days down. Okay. How about AP? Rounded. 19, 24, and 23 days. 19, 24, and 23 days. No industry comparison. I put NA not available, which is common. It's common not to always have this information. Inventory turnover in days. Pardon me. 91, 94, and 108. 91, 94, and 108. And the industry standard back on page 13 is 6.1. Well, wait a minute. 6.1 versus 91, 94, 108. It's 6.1 times. If you have a customer turning their inventory, let's just round it to 6 days or to 6 times. That's about every 60 days. So sometimes the industry comparison will not be in days. Traditionally, we like as commercial underwriters to stay days, days, days all the way. I'll explain that later when we get down to cash conversion cycle in a moment. Okay, now we need to do a little math to do the equivalent so that we can see inventory in times so that we can compare it to the 6.1 times. So the first period, you would take 365 divided by 91 days. And that will give you approximately 4.0. times. So receive on all of these, like inventory, but we want them to shrink in days or expand in times. It's the same concept, number of times. So now what about the second year, 2019? We take 365 divided by the 94 days. It gives us 3.87 times per year. The third period, the third year, 2020, pardon me, we take 365 and we divide that by 108. And that gives us 3.38 times per year. 3.38. Okay, now look at the numbers. The receivables are stretching out. The payables are tight. The inventory in days is stretching out, or in times is shrinking. It's the same effect. Times, we want less days of inventory. We want more times. But no, it's more days and less time turnover, number of times of turning over. And we know the industry comparison for inventory is the 6.1. Okay, now, what I'd like everyone to do is spend just a moment on this. Strong, moderate, or weak. Strong, moderate, or weak. Overall, self to self, self to industry is activity for Snyder Corporation. Strong, moderate, or weak, or a little hedge in between. Can always do a little hedge in between. Take just a moment, everyone. Take just a moment on this. What would you say? Strong, moderate, or weak? Overall assessment. Pardon me. What would you say? Those of you that are in little groups, and there's about 3 of them, boy, don't hesitate. Talk amongst your team members. Okay, here we go. Charisma, what would you say? Would you say strong, moderate, or weak activity for Snyder Corp?
I would say moderate to weak.
Moderate to weak, a little hedge there. I like, that's where we're really splitting the hairs. It's a good thing to be able to not just say strong, moderate, or weak. No, a little hedge. Thank you for that. Catherine Lee, what would you say activity is? How would you rate it?
I would say moderate to weak.
Moderate to weak as well. Ryan, how about you?
I'd say weak.
Weak, okay. Joey? Merlino? Merlino? What would you say?
I'd say weak to moderate.
Weak to moderate, go the other way. Okay. Evan, what would you say? Strong, moderate, or weak? Catherine Walker, what would you say?
I'm kind of on the same. It's kind of like a moderate to weak.
Moderate to weak. Okay, good.
Sorry,
Okay.
Dave, we were having, we're still experiencing those issues, but.
Oh, okay, no problem, no problem. I understand. I
I
understand.
agree with Catherine there.
Okay, agree with Catherine, good. Okay, now, that was excellent. Excellent analysis. I would say moderate to weak. There's some weakness in this, boy. Now look at cash conversion cycle. This is the step up. Well, what we just covered was the basic. Wow, now we're going to step this model up or add on. Cash conversion cycle is defined as follows. It is the average number of days that the company's cash, pardon me, is tied up in its current assets. The average number of days that the company's cash is tied up in its current assets. We want cash conversion cycle to shrink over time in days. It's all days. This is one reason why the commercial lender, usually in activity, AR, AP, and inventory, we usually stay in the world of days. Whereas some analysts will start using the term, the turnover. It's just the mirror image of each other. Okay, now look at the formula down below. Once again, defined as the average number of days the cash is tied up in the current assets. We want this to shrink. Pardon me, we take the inventory turn from up above plus the AR turn from up above minus the AP from up above. And that will give you the cash conversion cycle. Now, let me give it to you just to save time. If you put 18, 19, and 20, what is the ending mathematical result? It is as follows. Rounded 110 days, 110 days, and 131 days. 110, 110, and 131. Stable, stable, and then 3 weeks, 21 days. Not a good trend. Remember cash conversion cycle? We would prefer it to shrink over time. Better utilization of their cash. Absolutely. Now, how could Snyder Corporation improve? Bob and Sue, boy, they're based in Grand Rapids. They got the operation over in Wausau, Wisconsin. They got up in the UP, Marquette. Every so many months, they'll either drive or fly up to Marquette. Usually drive, take a few days, go up to Marquette in the UP. They say, wait a minute, our inventory is out of control. The local general manager of the plant says, well, it's because we're antiquated. Our process is 30, 40-year-old. Well, what's it going to take? 100,000. Okay, let's do it. It's worth it. All of a sudden, the inventory, boy, they put those changes in place. The inventory control, the inventory turn shrinks. What about AR? They say to the general manager of the whole operation up there, well, your AR is stretching out. Well, I've got a nice guy in that slot, but he just plays on his phone all day long. And then you say, then you're Bob and Sue, and you say, well, man, AP is too quick. It's too quick, which it is. I gave you the numbers. 19 days, 24, and 23. It's too quick. You got to stretch that out. And the general manager says, well, I got a very good AP manager, but she's too efficient. I constantly say to her, can you slow it down a little bit? Bob and Sue look at the general manager and say, well, we think you have the right people, the right two people, the AR manager, AP manager. You have them in the wrong slot. You just need to switch them. Get that AP manager collecting. Oh, and he does. And overnight, the AR shrink. And on the AP, Bob and Sue and just say to the general manager, well, tell that guy on the phone that plays on his phone all day long, it's okay to do a certain amount of that. Inadvertently, what happens to AP? Stretches out, which from a cash conversion cycle, it is a positive. As long as they don't, like we talked about earlier, as long as they don't stretch it so far that they get the company put on COD, cash on demand, cash on delivery from the suppliers. But they push right up to that edge. By doing so, improving all three of these, wow. Cash conversion cycle, instead of going from 110, 110 to 131, it'd go from 110, 110 to maybe 80. Wow. 80 days. That's a 51-day improvement. That's pushing 2 months. Questions on cash conversion cycle? Jeremy, any questions on this model, this advanced model at the bottom, page 15? Any questions on this one?
No, sir.
Got it. Excellent. Let's move forward. Page number 16, our third of our 5-step laylout model. Pardon me, debt divided, it's the debt ratio, debt divided by net worth or equity. We take total debt. Of course, how do we define leverage? The company's ability to service its long-term obligations. Some analysts, and these are usually not bank analysts, these I find are oftentimes CPAs or other analysts, not bank, not commercial lender, not commercial lending credit analysts like you, most of you are. But I find others, they will take long-term debt divided by net worth or equity. Whereas traditionally within our industry, No, we take comprehensive or the combined current and long-term liabilities combined divided by total net worth or equity. Have you put this down off to the right, 18, 19, 20, and IND. Let me give you the numbers. Okay, here we go. The first year, 18, the debt to net worth or equity, 1.21. 1.21. 2019, 4.18. 4.18. And lastly, 2020, 0.78. How do you interpret 0.78? For every 78 cents of debt, there's $1 equity. Whoa, that's low leverage. Look at the previous year, 4.18. For every $4.18 of debt, there's $1 of equity. That's how we interpret it. 1.21 for every $1.21 of debt, there's $1 equity. Why that middle year so high? They had the loss. They took on debt to support or cover the loss. Why is that third year, 2020, so extremely low? Remember, Bob and Sue sold off part of the business, and they took the money and they paid down on the debt. So the debt divided by net worth or equity just significantly lowers, which is good. Remember liquidity, current ratio, for example, the higher the better. This ratio, the lower is the better, the lower the leverage. More liquidity, less leverage. That's the ideal. Now, old-fashioned rule of thumb. Oh, by the way, before we forget to complete this, back on page 13, the industry is a 2.0. You may remember that, a 2.0. Okay, old-fashioned rule of thumb, a maximum debt to equity ratio of 3.0. It's an old-fashioned rule of thumb. For every $3 of debt, there's $1 of equity or lower, not higher, lower. Okay, we have the numbers, self to self. We have the industry 2.0. What, how would you, and we know the generic old-fashioned rule of thumb is a max of 3.0. Their industry is 2.0. More conservative, it's lower, which is good. How would you rate Snyder Corporation's leverage? And I know this one's challenging because there's so many shifts, partly because they sold off part of the business. Strong, moderate, or weak, or a little hedge in between. Everyone take just a moment. Those in our small groups, we've got 3 of them. Boy, talk amongst your team members in those groups. But you can make up your own decision as well. You don't have to go with the team, although it's nice to have a little feedback. Absolutely. Okay. Take just a moment on this one. Strong, moderate, or weak. Pardon me. How would you rate this third model of the 5-step model? Okay, here we go. Jack, what would you say? How would you rate this? Strong, moderate, or weak?
I would say moderate.
Moderate.
But at the same time, you could almost say strong because we don't know how consistent that 4.1.
Well, yeah, you're right on. Now, is this a true statement, Jack? If you had a statement, an interim financial statement through 6/30 of 21, and that same 0.78, pretty close, stayed the same, would that trend to push your judgment call to strong?
I think it would, yes.
You bet.
A little bit more.
A little more. Thank you. Graham, how about you? What are your thoughts?
Yeah, I'd agree with Jack on moderate to strong.
Got it. Joey Holman, how about you? What would you say?
I'll agree with Jack and Graham.
Okay.
Strong.
Okay, good. Okay, now one other concept we move forward. Look at the related concept. Bring this model to a higher level. Do you see subordination of debt? Let's say that Bob and Sue, instead of borrowing from the company, let's say they have lent $200,000 to the business. Okay. It's a liability on the business's balance sheet. Okay. So it's a liability. We've got to say to ourselves, well, if we're the bank, do we want that 200,000 available? If that company goes under, if Snyder Corporation goes under, do we really want Bob and Sue to step in line as a creditor, potentially in front of our bank? The answer is no way. We have them sign a subordination agreement. Now, those of you that use Laser Pro, it's in there. And even if you use ARTA, Compliance One, there's even another one, Flow, there's several other platforms or software platforms out there to generate your commercial loan docs. We have Bob and Sue sign the subordination agreement. Now, what does that really do to that 200,000? It makes it subordinate to our bank, so that if the whole company falls apart, oh, they're going to get in line as a creditor personally to their own business, but they're going to be behind whom? Us. They're behind us. We're ahead of them. I'd add this to your notes, one other thought. If you have them sign that subordination agreement, mathematically, in the key ratio, the debt divided by net worth or equity, you would take that 200,000 out of the debt or liability side and add it to the net worth or equity side of the equation. Absolutely. You take it out of the debt side, add it to the net worth or equity, which will improve the key ratio. That's essentially what they did when they sold off part of their business. They sold off part of the business, they took the cash and paid down the debt. Same concept. Absolutely. Questions on this one? Questions on this one? Matthew, any questions on this one, this model? Any questions?
Nope, I'm doing good here.
Good, excellent, thank you. One other thought, we'll move forward, just a little tidbit. For those of you that use Laser Pro, for whatever's worth, if you forget to have Bob and Sue sign an actual subordination agreement that's generated out of Laser Pro, in Laser Pro, I can't speak to ARTA, Compliance One, these other platforms, these other software programs, but in Laser Pro in particular, I suspect it's similar to the others as well, but in Laser Pro in particular, essentially every one of your loan documents, there is a subordination clause in every one of those. So if you do not take the formal form and reference to the promissory note, you're still protected, in my opinion. Why? Because all of the other loan documents that Bob and Sue signed says any debt that is owed by the company to you as owners of the company and you're our guarantors, guess what? It's subordinate to who? Us, the bank. Just a thought. Moving right along. Now, model number 4. Model number 4, operating performance. We said this earlier, the profitability of the business. We common size the income statement. We have debt sales. You can see this is not Snyder Corp. This is just an illustration, simple illustration with the numbers. $5 million, that's 100%. Cost of goods sold, 4.4 million divided into 5 million is 88%. Gross profit, 600,000 divided into 5 million, 12%. Pardon me, G&A, general administrative expense, the overhead, 350,000. Pardon me, 7%. And net profit margin is the 5%, the 250 divided by 5 million. I would highlight the 12% and the 5. In this fourth model, the two most important key ratios is the gross profit margin, which in this case is 12%, and the net profit margin, which in this case is 5%. Now, of course, we're going to have self to self, self to industry. We would have year-end 18, 19, 20, 6/30 of 21 interim, and we would have the RMA or some other study. relative to this industry and even sub-industry relative to this customer? Absolutely. Gross profit margin, net profit margin. Okay, let me ask Hannah. Hannah, do you bank any medical practitioners in your bank?
I don't believe so.
Okay. What type of businesses, don't know names, but what type of businesses are they that you work with? Are they manufacturers? Are they ag? Do you ever do a lot of farm credits? What type of industry roughly?
Yeah, we're mostly an ag bank.
Okay. Okay. A lot of times on the ag, you see that net profit margin, that's thin, way thin. Well, part of it is that the farmer, he or she lives in the business. Would you agree with me, Hannah, on that? They live
Yes,
in the
absolutely.
business. So their margins are usually very low. Here's another industry that's low. Hannah, besides farm is grocery stores, if you will. Oh yeah. They survive on maybe a 2% margin, net profit margin at the most. They make it up in the volume. Brad, Christy, and Carissa, if you'll chime into the chat, do any of you bank the medical practitioners, like an orthodontist, as an example? Do any of you three have an orthodontist, maybe not your account, but on your team or within your bank? Do any of you bank orthodont? Well, here comes the chat. Here's the response.
Yes.
Okay. Yes. Okay. We do.
Yes,
Good.
we do.
Okay. We've got a few that do. Well, boy, their margins, they really don't have a gross profit because they don't have cost of goods sold, but they have G&A, they have overhead, general administrative expenses. Their net profit margin, because I banked them, I've worked with them. Oh, 25, 30%, 40% sometimes. In some markets where there's not much competition, the orthodontists have a net profit margin 40, 50, 60%. Whoa, that is huge. I've noticed this for whatever it's worth in the Vegas market. Over time, we've been here 33 years. Well, used to be, as the city started to take off in growth, there were only a few orthodontists. Oh, they had a kid. They were lined, the patients were lined up out the door, literally, not figuratively, literally out the door. And I mean, you couldn't even get an appointment. Well, it's somewhat saturated now. But back in the day, their net profit margins were in excess of 50%, 60 or more. Wow. Look down below. Let's raise this up. True profitability, going back to the accrual versus cash basis. That CPA George, he can swing these numbers. He can swing these numbers back and forth all the way. All the way. Recognition, timing's everything. For example, going back to farmers, Hannah, you mentioned you bank a lot of the farmers. Your bank does? Well, farmers will do what? We'll see this tomorrow in our tax class, especially with the tax strategy. Pardon me, they'll buy their seed in the fall. When do they plant? In the spring. They take the write-off in the first fiscal year versus the second. Timing is everything, not just from a financial statement, but of course, tax as well. Moving right along, let's turn forward. The fifth and final of the laylock model. Now, we're going to do the three big. These are the foundational cash flow models. We're going to go, as I mentioned before, as we've been doing, go through the model, a quick pass, just to explain, and then dive deeper, dissect. I like it. I like the phrase dissect the model. Way deeper than normal. That's what we're doing in our advanced class today. Deeper, deeper, deeper. I beg of you, each of you, don't hesitate to ask questions. Few of you have already, but please, I encourage you. Here we go, cash flow. First off, lifeblood, cash in, cash out. The first one is the traditional EBITDA for the business. Then we'll do the personal for Bob and Sue, and then of course, the global. Okay, the EBITDA inflow is 1.2 million. Commercial lenders, we use 1M for 1,000, 2M for million, Roman numeral system. Just like a V is a 5, an X is 10, a 1X is 9, and so forth. An L is 50. D is 500. What is a C? 100. Inflow is 1.2 million minus the debt service of the business. P&I, principal and interest, 500,000 gives us 700,000 excess or margin. Pretty straightforward. 1.2 million inflow divided by 500,000 outflow gives us the DCR, debt coverage ratio, 2.4 times. Okay. Now that's the basic flow. Now your bank may call it a DSCR, debt service coverage ratio, same thing. Heather, by the way, Heather, what does your bank call that? Do you call it a DCR or do you call it a DSCR?
DCR.
DCR, just like this. Okay. Now, that's the basic model, the basic flow. Let's dissect. First off, number one, 3 years of interim, or pardon me, 3 years of year end and then an interim. Year end 18, 19, 20, and then 6/30 of 21. Number one. Number two, here we go. Look at the inflow. Earnings, net income, net loss before add back interest expense. Why do we add back the interest expense? Well, it's because we take out the debt service down below, the P&I, principal and interest. That's number one. Number two, interest expense has already been taken out of the earnings or net income, net loss. So we've taken out twice. If we don't add it back in, we've dinged them, quote unquote, dinged them twice. What about the T? The T of taxes. You would only have, and I would put this above the T, a C Corp is the only situation you would have the T to add it back in traditionally. Why not for an LLC or an S Corp? Well, those are pass through for tax purposes. We don't add those back in. The T, there is no T in an LLC or an S Corp. No income tax. They have other forms of tax, property tax, whatever, but not income tax. This is the specific reason why we add the T of taxes back to a C Corp. In a C Corp, taxes, income taxes are considered non-operating expenses. Non-operating expenses. They're after the operations. So we add them back into the model. Why? Well, because every year, because the C Corp is a tax-paying entity, the accountant, George, will look at the strategy of how to avoid the payment of tax legitimately. So that so their position relative to corporation, the C Corp's position relative to tax could be different from year to year. So in order to not let that disrupt our cash flow, we will add back the T of tax. It's a non-operating expense. What about the D? Depreciation. We talked about that extensively earlier in our accounting section. Add it back in, except, pardon me, if you're using the tax return, the section 179, a little controversial, depending on what your bank's position is. Every bank's a little different, but whatever you do, be consistent, as I mentioned earlier, please. A for amortization, we discussed earlier. I'd add another D. Add another D, depletion. Depletion. Absolutely. Now, a couple other tidbits.
What's up?
Another couple other little tidbits. We'll
Cash flow.
continue. Okay, here we go.
Yeah, they're doing pretty good.
Okay. Well, there's some feedback there. I love it.
My bad.
Here. Okay, here we go. Add this to your notes if you would, please. How do you interpret the 2.4? For every $2.40 of inflow, how much outflow? $1 outflow. Look at the industry standard. Our minimum nationwide today is a 1.20. Okay, James, what about at your bank? What's your minimum debt coverage at your bank?
I wouldn't say we have a minimum per se, but I mean, obviously, we want to see at least one at break even.
Oh,
But-
good
And
point.
then just business wise, and then globally, we'd want like 1.2.
1.2, good. Okay, thank you for that feedback. Okay, now Another thought will move forward. Put right next to EBITDA, and you added a D. So EBITDA, put an R. What's an R? Rents. Every once in a blue moon, you will see an EBITDA inflow. DAR. What's the R? Rents. Okay, here we go. In most situations, when Bob and Sue approach you to finance the purchase of a new building, they've been renting their office warehouse facility in Grand Rapids, their main headquarters. Oh, they're tired of that. They want to own their own building. Now they have the opportunity to move just a half a mile away, own their own building. New business park just opened up. Developer built the infrastructure, boom, built the buildings. They're going to buy the buildings, retrofit it to their needs. In most situations, George, the CPA, will advise the client to set up another LLC to hold the single asset LLC to hold the building. And the building is leased back to the operating business, ABC LLC. It's the most common structure. But every once in a while, you'll see where the operating business is also the borrower for the building. It's not advisable from multi-levels, tax, legal, on. We could be here all day talking about why you would split those. Of course, Bob and Sue own both businesses, and they lease their buildings leased to their own company, of course. But let's say they obtain your building loan, your commercial real estate loan, in the name of the operating business, ABC LLC. Okay. Well, you go to underwrite this new CRE deal. Okay. Or even just a line of credit or their equipment loan or whatever. Maybe the commercial real estate loan's already in place. Okay. CRE loan's already in place. So you say, okay, I'm going to do the cash flow for the business, but I want to be more comprehensive. They're not going to have rents from the old building going forward. They're vacating that building. So you would add back the rents up above, make this not EBITDA, but EBITDAR, D-A-D-R at the end, and then show the building payments, the P&I payments on the commercial real estate, the CRE loan down below on the debt service. But up above, you would add back the rents. Now, with this exception, what if they obtain the loan in their operating business name, which is not common today? But let's say they tell you, oh, well, we're growing so fast. We're going to keep the old building and buy the new building, have you finance the new building. Well, in that case, you're not going to add the R back, the rents back. No way. Why? Because they're going to have both the rent payments on the first building and your new P&I payments on the new CRE loan for the new building. But in most situations, oh no, we're done. We're done being a tenant. We're now an owner in the building. Questions on this? Alexa, you'll type into the chat. While we wait for that, Zach, any questions on the EBITDAR with an R? Any questions on that? Okay. Angela, any questions? Any questions, Angela?
Not right now.
Okay. Makes sense with
David,
the EBIT.
I have a question for you.
You bet. Go ahead.
Would you consider making this an EBITDAP with a P at the end of it for PPP loan forgiveness?
Whoa, whoa. Maybe. I'm going to hedge. We're going to see this tomorrow in our exhibit number 3, the PPP.
Beautiful.
From a tax standpoint, we're going to say it just like right here, because some of you won't be here tomorrow. So let me just briefly explain it. Per the tax code, the PPP forgiven portion on the top end is not taxed. And at the same time, this is in 20 and most likely in 21. At the same time, the the expenses that were used to calculate the PPP forgiven amount is still tax deductible. So quite frankly, the inflow is not taxed, the outflow is not taxed. Now, so from a tax standpoint, oh, it goes away. What about from a cash flow standpoint? Some lenders will add back the PPP on the inflow. They're still writing off the expenses down below. Traditionally, you would not do it, but traditionally we don't have PPP. It's something, it's a modern phenomenon. Just like this pandemic. We haven't had a pandemic like this since 1918, 1919, called the Spanish flu. Well, I would probably tend not to do it for a couple of reasons. Number one, it's not taxed. Number two, in theory, it's not going to continue. We had one draw, we had a second draw. I was with a group of lenders, ground-based, a few weeks ago, and somebody blurted out, "Are we going to have a third draw?" And everybody laughed, and then they all booed. They laughed, and then they booed. Why did they boo? Because they didn't want to work on the PPP. Now, who asked the question? I didn't catch the name. Who was it that asked this?
It was me, Andrew.
Andrew. Okay, Andrew. Do you think, Andrew, that we're going to have a third draw?
Absolutely not.
Whoa! Did you hear that? No way.
But we actually loved PPP because of all the small businesses that we helped out. But from our bank's perspective, we actually add back the cash flow because we know from a tax perspective that it may not make sense to do so, but from a pure cash flow perspective, we think that it's being significantly too conservative not to add it back because otherwise, if there was no PPP, the argument is that, well, they would have, maybe let go of some additional employees, cut some additional expenses like rent and stuff like that.
That's a good argument. Now, let me ask you, Andrew, you add it back on the top end, but do you keep the same expenses down below that were used to justify the top end? Do you keep those as outlays? Absolutely. Okay, then I can buy it. I can buy it. I just, from a big picture, I'm still concerned that it's a short term, is it going to happen again? You said, no way, no way. Well, and maybe, and this is for year end 20, you're doing this, correct?
Yes, we have some people, 2021 forgiveness has already started and we've had some that are going through that process. But yeah, we typically only apply it fully to somebody who has received forgiveness, but we're also at like 95% plus of our PPP loans that are getting fully forgiven, which is fantastic to see.
Yes, yes. I have CFO clients right now that I've been working with since PPP first came around. In fact, when it first hit, and it's kind of a misnomer, this is not to speak out of school, but the first draw was not the first draw. The first draw went to the big corporations, the big universities, and so forth. In my opinion, it's a misnomer. We'll talk about it more tomorrow, but the first draw was really to these big corporations, and they gobbled up the money, and Harvard University and all this. I can say it's public knowledge. It was in the press. So when we say first draw, second draw, in reality, it's second, third, in my opinion. But as far as most of your clients, it's first and second draw. I can see maybe for that 1 year adding it back in. But it depends on what happens going forward. Who knows? What happens with the pandemic? Who knows with the numbers, with the COVID numbers? Who knows are we going to have a third draw, a fourth draw? Well, if it becomes a more regular way out, then I would definitely say, oh yeah, add it back in because it's going to be a more recurring for at least a couple of 3 years, maybe. Hopefully not. Good point. Good thing to bring up. Excellent. Any other comments on this one? Any other comments? Let's move forward, if you will. Turn to page number 19. We're going to stop right there. And we will take our first 5-minute break of our 2 breaks in the afternoon. Take a 5-minute break. We'll come on back. We'll do the personal cash flow for Bob and Sue, and then we'll do the global. And then we're going to move into our third area in more advanced cash flow modeling. Although you can see we're digging deep in some of these, you bet. Talk to you in 5 minutes, everyone. Thank you. Welcome back, everyone. We'll take just a moment and we'll continue forward. Take just a moment as we get back together. Okay, Jordan, will you do our sound check for us, please? Give everyone just a moment. Well,
Yes, I'm here.
yep, we got you. Thank you, Jordan, pardon me. Jordan, thank you so much. Now, before we continue, are there any questions? Any questions? Okay, let's continue. Here we go. Personal cash flow, business owner Bob and Sue, guarantors. We take from the 1040 tax return plus the schedules plus the K1 pass-throughs. Total inflow of 500,000. We'll do the basic model, then we'll go back and dissect. 500,000 annual minus federal and state taxes, 150,000. Gives us 350 cash flow available for debt service. Minus Bob and Sue's personal debts, 200,000 annual. Gives us the margin of 150. 350 divided by the 200,000 gives us the debt coverage ratio of 1.75. Okay, that's the basic flow. I recognize most, if not all of you, work on these. Now let's dive deeper. First off, we would have three columns. Year end 18, 19, 20. There is no interim, so we don't have an interim cash flow. We could do a projection, but typically based off the tax return, it's just 18, 19, and 20. Look at the inflow. Salaries, business income, rental, K1 pass through. For those individuals that will not be with us tomorrow, and for everyone, we'll cover this again tomorrow, but if you would put off to the side in your notes, here's the cash flow formula to read the cash flow from the K1 of the LLC or partnership to Bob, the K from the LLC or partnership to Sue. Each of them have a K1. For the K1 for an LLC or partnership, here's the formula. It's line 19A, distribution from the business to Sue. Let's say it's Sue's K1, plus line number 4C, which is guaranteed payment to partners, minus box L, line number 2, which is capital contributed back to the business. It's line number 19A, the distribution from the business to Sue, plus 4C, guaranteed payment to partners, minus box L, the contribution, if anything, from box L at the bottom left-hand side of the K1 back to the business. That net number is the cash flow from the business to Sue. We do the same for Bob. What about an S corporation? The K1 is a little different. Once again, we'll see this tomorrow, but for those that aren't going to be able to join us, let me give you the formula. The K1 for the S corp is as follows. Line 16D, 16D distribution. Let's say Bob owns this S corp by himself, to Bob, minus any dollar amount that he contributes back to the business. But nowhere on the K1 form for the S corp is there a box or a section that shows how much he contributes back to the business. So how do we find it out? I put in your notes, we asked Jane, the CFO, to confirm that number. Jane is not only the CFO for Bob and Sue's combined business. Bob may have a business on, by himself. Sue may have a business by herself, whatever, it doesn't matter. They may own combined 5 or 10 businesses. Jane is the person to talk to, the CFO. Once again, box 16D minus, which is the distribution, minus confirm with the CFO, did Bob contribute anything back to the business? Federal and state tax, you're either in Wisconsin or Michigan. You both states are tax-paying states. but I'd put a number 9 below the word state. There are 9 states that have no state income tax, including Texas. Texas is one of them. If you're in Texas, there is no, that you just subtract off federal, there is no state tax. Cash flow available for debt service minus the debt service gives us the margin or excess. The cash flow available for debt service divided by the debt service gives us the DCR or DSCR. Okay. 2 other concepts we move forward. Number 1, let's dissect deeper. Right below debt service, if you would please put living allowance. Starting about 4.5 years ago, the federal bank examiners started to say to the commercial lenders all over the country, pardon me, we want a living allowance in this analysis. Okay, I'm going to ask Dwight, do you include a living allowance as an additional outlay of cash? And if you do, how do you mathematically calculate it? Dwight?
Yes, we do, and it's based on their total cash flow.
Okay, so some sort of a percentage. What percentage?
It's like, so it does ranges, so like 0 to 35, and then single and 2 people, and then any like certain different steps along the way, and then anything over 120 is like specific. So it's got like a
tier, like a tier almost.
Yeah.
Okay, good. I like that. Interesting. Okay, Andrew, how about you? Andrew, how about you?
Yep, we do a simple calculation based off of their personal cash flow. We do the lesser of 20 or the greater of 25,000 or 20% of their like gross personal cash flow.
Oh, okay.
But at times we'll also maximize that because, you know, sometimes people show just because they had a massive distribution, they might show a huge like $300,000 living expense. That's probably unlikely with most of our customers. So.
Hopefully, yes. Good. Thank you. Charisma, what about you? How do you calculate it? Or do you calculate living allowance? And if you do, how do you do it? Do you include that?
Ours is it's a ratio that's just or a amount that's just provided to us. It came into play before I started my positions. I'm not sure how it's calculated, but it's just so much per person essentially.
Okay. A lot of banks just, thank you for that, Charisma, and everyone, those were good. A lot of banks just keep it simple. It's 15,000 per adult, 5,000 per child or dependent. So Bob and Sue, 15, or 30,000. Do they have 2 dependent children, 5 and 5 or 10? Combine the 2, 40,000. Here's another way it's done often. You see cash flow available for debt service, 350,000 times 20. We times that by 25 or 35%. And then whatever that raw number is, we tuck it right down below the 200 as an additional outlay of cash. Good. Look at the minimum standard, debt coverage. 1 to 1.4, although I found in the last 3-4 years, most banks have gravitated on this cash flow to more of a 1.20, like the EBITDA. There's a comment from the chat. Okay, this is from Brad. We do not too subjective. We keep it in mind, but don't have a formula. Interesting. Good. So they don't have Brad from Wisconsin doesn't, they keep in mind, but they don't have an actual formula. Most lenders do though, Brad, for whatever's worth, most lenders do. And most debt coverage ratios are about a 1.20 minimum. Okay, one other thought we move forward. You notice we've added the distribution from the business to this personal cash flow up above, K1 pass through. And I gave you the formulas for both an LLC partnership and an S corp. If you turn back with me 1 page to page 18, you notice we didn't take out the distribution. To be more accurate, in my opinion, right below EBITDA, or with maybe even below, probably below the debt service or right above it, somewhere in this, we would subtract off the distribution from the business to Bob and Sue. If we're going to count it personally, well, where did it come from? It came from the business. So it comes out of the business cash flow, which you see here on page 18. But it's not there. I put a little note off to the side on this particular EBITDA, back to EBITDA. A lot of banks in America do not take out. A lot of the commercial underwriters, credit analysts, loan officers, what have you, they do not take out the distribution out of the business cash flow. But moving forward to page 19, they add it here. Illogical, in my opinion. If you're going to add it one place, where does it come from? It's got to come from the business. But a lot of lenders do not do that. I would dare say the majority, I would dare say at least somewhat of a majority. They do not subtract the EBITDA, or pardon me, from the EBITDA, the distribution, but boy, they add it here. Kind of interesting. Let's turn page number 20. Our third and final of our foundational models, but as you can see, we're adding on, we're dissecting deeper than traditionally in a basic cash flow class. Global cash flow, nothing to do with international trade, international business, or banking, simply a combination. This one's pretty much required by the feds, starting about 4.5, 5 years ago. Business cash flow combined with personal, combined margin, combined DCR. Okay, let me ask a couple of you. Catherine Lee, do you do a global cash flow in your write-ups, in your analysis?
Yeah, we do a global.
Okay. What is your minimum DCR standard? Do you
One.
have a, pardon me?
1.20.
1.20, Catherine. That is the most common nationwide. Your bank is right there with the nation, the whole industry. Okay, let's do a class shout out. Do we have anyone in our class? And thank you, Catherine, for that. Do we have anyone in our class that does not do a global cash flow? I don't mean to put you on the spot. I'm just we're amongst friends. You can just blurt it out. Don't tell us your name. Don't remind us your name. But do any of you not do global cash flow? Okay. All right. Thank you for that. It's interesting because over the last 2 years or so, it used to be up until, even like 3 years ago, boy, a lot of people said, we don't do them, but we're going to start. Now, most everyone does them. So only a few people now I find, but we don't do them yet. And you notice it's yet. Ryan, what's your minimum on this one? Do you have a minimum debt coverage ratio, Ryan, on this, on the combined DCR? Catherine said hers was 1.2. What about yours? Do you know?
It's not necessarily a minimum, but we prefer to see like a 1.2.
Got it. Okay, but you're somewhat flexible. Good. Thank you for that. Let's move forward. Page number 21 now. We're going to skip over. We're going to come back to UCA in a minute. Let's look at the Moody's spreadsheet. Turn to page number 1 of the spreadsheet, top right-hand side. Bottom of the page is page 22 in the main PowerPoint. Okay, this happens to be a Moody's spreadsheet. This is a real client of mine, sample contractor. Look at the years. This is back in the Great Recession. That's why I like to use this as a case study. It's a real company, real numbers. This particular company does fire, flood, and mold remediation. There's a house fire in the kitchen. They come in, they're the general contractor. They hire a framing contractor to frame out the wall that was burned, electrical, plumbing, even a painting and drywall subcontractor. Okay, before we get into this, I need to ask a couple of you. What software program do you use to spread the numbers? Joey? Merlino, what software program do you use? Moody's, SageWorks? Do you use Excel?
We use Excel.
No problem. No problem. I've seen some Excel spreadsheets that would rival expensive Moody's or SageWorks, whatever. Evan, how about you? Evan, I know we've had some technical difficulty there. Catherine Walker, how about you?
We use SageWorks.
SageWorks, okay.
Be the same for Catwalk.
No problem. Go ahead, Catherine.
I don't know. I'd have to refer back to Dwight, Evan, and Mo and Catherine
Gotcha.
to find out what they use.
Okay, no problem. Jeremy, how about you? What about your world? What
SageWorks.
software do you, pardon me?
We use SageWorks.
SageWorks, okay. Excellent. Now, we load the balance sheets up, we spread the numbers, turn the page 23 of the main PowerPoint, page 2 of the spread. We load the income statements. Of course, these are in thousands. Move forward to page number 24. This is basically the common sizing of the income statement. This is model number 4 in the Laylock model. And then we go forward. We're going to bypass page 25 for just a moment, come back in a few minutes. And then we go to page number 26. Page number 26 is our key ratio page. Now, top left-hand side of this page, if you would please, pardon me, next to the word liquidity, if you put a number 1, you put a number 1 right there next to liquidity. Okay, about 2/3 of the way down, activity, if you put a number 2, just put a number 2 there, please, model 2. Go back up towards the top on the left side, you'll see the word leverage. I put a number 3, our third model. And then in the middle of this, do you see profitability, operating performance? I put a number 4. And then just up above that, the words cash flow coverage and number 5. Now, we see the Laylock model here, but oh, there's a lot of numbers. If you'll turn with me to page number 27. Everyone turn, please, to page 27. This is a spreadsheet that I prepare as a takeoff of that last page to simplify it. You say, well, where did you get these numbers? They came from the previous page. But all I've done is put them in the Laylock order with a little bit of definitions. I've also added, as you can see, the Risk Management Association or RMA comparisons or comps for short. Okay, what I'd like to everyone to do, take a couple of minutes on this. Look at liquidity, look at working capital, self to self, self to industry, like we saw before. There is no comparison, it's a raw number. Look at current ratio. I'd slash through the 4.91, odd number. But look at the rest of the trend. Self to self, self to industry. RMA oftentimes has a range of numbers. You see the 2.5, the 1.2, and the 0.7. Then go down to activity. AR turn, AP turn. Self to self, self to industry. Look at the 3 days for 08. For AP, I'd slash through odd number. Then go down to debt divided by net worth, the debt to equity ratio. You notice they're all negative because it's a negative net worth. But look at the industry comparison. Wow. Operating performance, model number 4. You can see gross profit margin, self to self, and the industry. Net profit margin, self to self, and the industry standard. And then the raw number. Pardon me, and then cash flow down below, EBITDA. Okay, cash after debt amortization. What I'd like everyone to do, spend just a couple of minutes, look at liquidity as a body, as a total. And after you analyze self to self, self to industry, comprehensive, to the right, put in your notes strong, moderate, or weak, or a little hedge. Weak to moderate, moderate to strong, strong to moderate, moderate to weak, you name it. Then go to activity. Overall, you can do the individual AR and AP, but when we come back together as a class, we're just going to talk about the comprehensive, like we did before. Strong, moderate, or weak, a little hedge. Leverage, do the same, operating performance, and please, lastly, cash flow. You'll have just 5 ratings at the end, over to the right when you're done. Take just a few minutes. We're not calculating, we're interpreting. We're quote unquote assuming these underlying financials are clean and that we've spread the numbers, or our analysts have spread the numbers clean. Now it's our job, our duty to do what? Interpret the numbers, interpret the financial condition of this borrower or proposed borrower. Should we lend to them or should we run the other way? Take just a couple of minutes on this, please. Go ahead and proceed if you would, please. Pardon me.
Hey, David.
Yes.
Myself, Joey Holman, Jack Korth, and Graham Carlisle, we have to step out for a separate meeting at 2:00. But
Okay.
we'll watch the recording as
Oh,
soon
you
as
bet.
that's done.
Oh, no problem.
Today.
Okay. You
And
bet.
then we'll see you tomorrow at the tax return one. So we're looking
Okay.
forward to it. Thank you so much.
Oh,
for your
you're
help today.
welcome. Thank you, Andrew. This is Andrew, right?
Yes, Andrew Ketron.
You bet. Thank you.
All right. See you tomorrow, David. Thank you.
See you
so much.
tomorrow. Thank you.
Yep.
Thanks,
Thank you.
David.
See you tomorrow.
Thank you. Take just a moment or so, everyone. Just a moment more, if you would, please. Strong, moderate, or weak, a little hedge, all 5 of these. Just another moment or so, and we'll summarize the Laylock model. Okay, here we go. Matthew, liquidity overall. Strong, moderate, or weak, a little hedge in between. What would you say?
I'd give them a weak to moderate.
Weak to moderate. Thank you. Hannah, what about you with liquidity? Hannah, what would you say? Okay, Brad, Christy, and Carissa, what would you say on liquidity? You'll type into the chat. Oh, here we come. They're already responding. Okay. Christy says weak. Brad says weak. Okay, thank you. Now, what about activity? Moving right along, Heather, what would you say on activity? Strong, moderate, or weak on activity?
Moderate to strong.
Moderate to strong. Okay, activity. James, how about you? Activity. Model number 2, strong, moderate, or weak, a little hedge.
I was gonna say moderate, but I could see the argument for moderate to strong.
Okay, thank you. Alexa, if you could type into the chat while we wait on that. Zach, what would you say on leverage, model 3? Zach, if you're with us, what about model 3? And Alexa, if you can type in while we wait on that. Angela, how about you? Angela, what would you say on leverage?
Weak.
Weak. Okay. All right. Jordan, what about you on leverage? Strong, moderate, or weak?
I would say weak.
Weak. Dwight, what would you say? Strong, moderate, or weak? I think Dwight may have been with the group that had to leave. I think he was. Okay. Dwight's
still
there.
here, Dave.
You're still there. Okay.
Yeah, I'd say moderate based on the industry average.
Okay.
For leverage.
Moderate. Carissa, what would you say on leverage? Strong, moderate, or weak? Okay. All right. Catherine Lee, what would you say on leverage? Strong, moderate, or weak?
I'd say moderate to weak.
Moderate. Moderate to weak?
Yep.
Okay, good. Thank you. What about model 4 operating performance? Charisma, what would you say? Strong, moderate, or weak?
I would say moderate to strong.
Moderate to strong. Ryan, what would you say on operating performance?
I'd say moderate.
Moderate. Okay, good. Moving right along, what about cash flow? Lifeblood? Joey Berlino, what would you say? Joey, what would you say?
I would say moderate.
Moderate. Evan, what would you say on cash flow? What would you say, Evan?
He stepped out for a second, but we'll go with moderate here.
Moderate. Okay, my opinion, liquidity weak. Activity moderate. Leverage moderate. Operating performance moderate to strong. Boy, if they had a longer period than that 1 month, with that same performance, I'd say strong on the operating performance. Cash flow. Probably moderate to weak. Moderate to weak. Moving right along. Excellent. Thank you for that. Now we're going to go into our third of our 4 sections today's presentation. We're going to now, we've completed the laylock model, including the cash flow analysis, business EBITDA, personal and combined global. If you'll turn with me back, pardon me, to page number 25 in the PowerPoint, bottom right-hand side of the page, page number 4 in the spreadsheet, top right. We're going to cover in this third section the 3 cash basis cash flow models. And then we're going to tack on a couple of 2 miscellaneous cash flow models I think you'll find interesting, and then we move forward from there. Okay, the UCA stands for Uniform Credit Analysis Cash Flow. So on page number 25 of the PowerPoint, or page 4 of the spread, page numbers are on the top right-hand side for the spread. The UCA cash flow, Uniform Credit Analysis Cash Flow, otherwise known as sources and uses of cash. You can see, look at 09. We're going to start with 09. And once again, boy, this was the height of the Great Recession. That's why we like to use this. Look at this case study. 3 cash basis cash flow models. This first one, then we're going to look cash basis, then we're going to look at the FCC model. These 3. Then we'll do those 2 miscellaneous ones in this section 3. Look at this. We're going to read the sources and uses. This is a throwback to a degree to earlier in our session, in our accounting section, where we talked about statement of cash flow, sources and uses of cash. If you look with me, in fact, this statement is a modified, this UCA cash flow is a modified version of the direct method of the statement of cash flows. It's a modified. It's similar, but a little different than what the CPA George would prepare. If you look with me, you can see the 906,000. Okay, these are in thousands. That's the revenue. That's a source of cash. I put an S next to a little S. Look at the next line down. Receivables from 08 to 09 dropped by $9,000. Well, wait a minute. Is that a source of cash? Oh, it is. I put an S by the 9,000. Why? Because the receivables are no longer out there. The check is no longer in the mail. The check is in our pocket. The company has received or collected. So if a receivable drops, it's a source of cash to the business, because what replaces it traditionally is cash. Look over to the right. Look at the 50,000. Receivables dropped even further by 50,000, source of cash. But then in 11, as the economy started to heal, they started building back their AR base. It's a negative 16,000 because the receivables grow and the cash are sucked up into the receivables. Get down to the contract cost, 712,000. Well, that's a true outlay. That's a use. I put a U. Look at the next notch down. Look at the next one down a couple of notches. Do you see change in accounts payable subcontractor, $55,000? Okay. Well, wait a minute. What happened from 08 to 09? Payables, not receivables, payables increased by 55,000. That is a source of cash. Well, why? Well, because Bob and Sue, they do what? They lean, it's the slang term is they lean on their suppliers, or in this case, their subcontractors. The painting, the framing contractor, the plumbing, the electrical, the painting and drywall subcontractor, all of those people. If the company slows its payables and it's not paying its bills as timely, it retains more cash, 55,000. Look at the next 2 periods. Pardon me, 5,003. Whoa. Why are they so low? Well, because by 2010, the economy started to heal. And in this particular client of mine, they had to start catching up on those payments. Well, as the economy healed, they started to heal, and they had stronger cash and cash flow to do what? To pay those payables. Go down to general administrative. We saw that before. G&A expense. 159,000. That's a use of cash. Officers comp. There's a use of cash. 170,000. Go down to the middle of this page. Net cash after operations. I would highlight or circle that whole little section right there. Now, what is net cash after operations, or NCAO for short? It's literally what the title is. It's the net cash that's available or left over after the normal operations or have happened. Okay. Let's continue. About 3/4 of the way down on the left. Do you see right there on the bottom left? Change in ST or short-term loans payable to the bank. I put in your notes, that's the line of credit. That's the line. When you go to the right, you see the 82,000, the -17 and the 40. Well, what is that? Well, those are advances off the line of credit. They advanced 82 the first period, paid back 17, advanced 40 again. Okay, good usage of the line, but it wasn't really good usage. Why? Look at that first period, 2009. They put the line of credit in place. End of 08. Look at what they did in 09. They took 50,000 off of that 80, out of the 82, and paid off a long-term debt. You see the -50? So they source of cash, 82,000, draw off the line, paid down at least 50 of it, paid down on the long term, it paid off that long-term note. You may think, well, that's okay. Well, no, it isn't. Over to the right in that little blank spot, if you please, everyone put in your notes, please. 2 concepts. Concept number 1. We want our borrowers to finance their short-term or current assets with current liabilities. We want them to finance their current assets with current liabilities. For example, current assets such as accounts receivable, inventory, finance with the current liability, a line of credit. Okay, short-term matched up. What about long-term? Concept number 2, long-term assets should be financed with long-term liabilities. Long-term asset, a piece of equipment. Long-term related liability, a 5-year equipment note or loan, 5-year fully amortized. Do you see what this customer did? They mixed the two. They took a short-term liability and refinanced, paid off a long-term debt. They mismatched the worlds. Why did they do it? Because their CFO told them to do it. Who's that? That's me. Was it a mistake in the end? Oh, yes. Let me illustrate. But when we did it, when I had this client do it, this client, the recession, the Great Recession had not caught this client yet. This client had 20 contracts lined up. Well, who are the contracts with? State Farm, Farmers, Allstate, all these insurance providers. Why? Well, because when there's a house fire or a fire in a business, who pays for it? Well, it's the insurance that kicks in. Okay, now what happened? I said to the customer, my client, I said, oh, let's take that line. Let's just pay off that long-term note. He looked at me, he goes, wait a minute. You've always told me short-term, long-term, long-term. Now you're saying take a short-term liability to pay off long-term. Oh, we're kind of mixing the worlds. I said, well, there's always exceptions. There's 20 contracts. He goes, oh, yeah, you're right. And even though the Great Recession had already started, it had not caught this client yet. What happened a month and a half after we did this? After my client did this, paid off the long-term note. About 17 or 18 of those 20 contracts dried up, just disappeared. evaporated into thin air. The recession was now on, and it was on with this client. Wow. Was that a mistake in the end? Yes. What happened in the end? You don't see this in 11. Look over to the right. You see how they advanced 40? Well, they weren't able ultimately to revolve the line of credit. And so the bank did what? The bank was forced to term out the line. There's an old saying, when in doubt, term it out. Okay, Catherine, have you ever seen a line of credit termed out because the client or customer of your bank could not revolve the line?
Yes.
Oh, you said that with a little laugh. I love it. It's true. Jeremy, how about you? Jeremy, have you seen a client do that?
Yes.
Oh, absolutely. Absolutely. Moving right along, unfortunately. Now, if you'll turn with me, look at the very bottom of this particular UCA cash flow. Do you see the 52,000, the 28,000, the 60,000? Those must balance to the cash position on the balance sheet, like we talked about before, way earlier today. To make this all balance, those numbers have to balance. And they do. If you go back about 5 or 6 pages back to the balance sheet, look at the cash position for those years, and they're there. 52, 28, and $60,000 respectively. Excellent. UCA cash flow, real cash. When I was on your side of the table at Bank of America, oh, we had a credit administrator named Paul. You would walk in his office with your loan write-up, and including your spreads were attached. And he'd review the deal. And when he'd look at that EBITDA cash flow, he'd just mumble something and just bypass it. He would go right to this page and start quizzing you on, well, okay, look at this, look at that, look at their receivables, their payables. And his common comment was he would zero in on officers' compensation. And it didn't matter what company or who the principals were. Didn't matter if they were conservative or not conservative. Paul's comment was, they're paying themselves too much. They're paying themselves too much. And then he'd grumble and so forth. Okay, now, this is the first of our cash basis cash flow models. Let's do a quick class shout out. How many of yes or no? It's a yes or no, including in the chat. Do you look at on a regular basis the UCA cash flow? Do you use this in your analysis, your financial analysis? Yes or no? Everybody unmute. Everybody unmute and say yes or no.
No.
Yes.
No.
Okay. Well, we got more no's than yeses on this one. Brad in the chat says no. Christy in the chat says no. Wow. Only a few say yes. I want to emphasize, this is true cash flow. It's not that inflated EBITDA stuff, even though EBITDAs are traditional in our industry. This is the first of our 3 real cash basis cash flow models. Let's move forward. Before we do so, any questions on this particular cash flow, reading the sources and uses? Any questions on this? Okay, let's go forward to page number 28. Our second cash basis cash flow model called cash basis cash flow. Now, this model, you don't see that often in our industry. Before the Great Recession, it was common. After during the Great Recession, 08, 09, 10, no way. Because it just shows too much real bleeding, if you will, hemorrhaging of the cash flow of the business. Some banks are starting to use this a little bit today. Fast forward all the way to the last few years, but it's still not as popular because, I'll just say it straight out, because there's too much truth to it. And the numbers traditionally are lower or weaker than the traditional EBITDA, somewhat inflated accrual-based cash flow model. Okay, let's go through the analysis. First off, we'll do the simple review, and then we'll dissect it deeper. Okay. NCAO, this comes from the UCA cash flow model we just covered on the spreadsheet. So the middle of that page, I had you mark the big black horizontal line. NCAO, net cash after operations. So that's where you get the number. Now this number of 800,000, this doesn't match the actual case study standard corporate, or pardon me, sample contractor. No. That was like 19,000 or negative 8,000, whatever. These numbers are just plugged in to illustrate this model. But that's where you get the inflow from, the net cash after operations from the spreadsheet, UCA spreadsheet or analysis. 800,000 inflow minus there are 3 outlays of cash. Mandatory capital expenditure, 100,000, this make-believe example. Dividends or distributions, I put / distributions, 350, and then the debt service, 300. Off to the right of those 3, if you put a little caret and put 750. The inflow is the 800,000 minus the outflow, 750, gives us the margin or excess of $50,000. Pretty straightforward. 800,000 inflow divided by the outflow of 750 gives us the debt coverage ratio of 1.07 times. Okay, that's the basic model. Now let's dissect it. Well, first off, we know the inflow, NCAO, is from the 800,000 from the spreadsheet, the UCA. What about mandatory capital expenditure, sometimes called mandatory CapEx for short? Well, we asked Jane, the CFO, well, how much do you think you're going to have this next year in capital expenditures, large expenditures? Well, about 100,000. We're going to buy a couple of used trucks. She says, I just talked to Bob and Sue about this the other day. A couple of used trucks, some equipment, that's about it. How much are they going to pay themselves in the form of a distribution? Oh, 350. Whoa, but she goes, we anticipate a strong year. What about the debt service? We already have that. We do the math, 800 minus 750 gives us 50. 800 divided by 750 gives us 1.07 times. Now, of course, we would have 3 year ends, 18, 19, 20, and 6/30 of 21 interim, of course. Now, let's go back to that 1.07. That's a thin margin. Break even is 1-to-1, 1.0. But I put a little note next to this one. This model does not have a minimum. This model does not have a minimum DCR or DSCR. Most underwriters that use this model would like to see at least a 1-to-1 because it's $1 in of true cash, $1 out of true cash. So there's not the proverbial 1.20 like in the EBITDA. Absolutely. In fact, let's dive even deeper. I would put this in your notes at the bottom of this page. What if you had a client, a customer of yours that has a debt coverage ratio in this model of a 0.95 the first year, 0.93 the next year, and a 0.97 the third year? They're just a little below the 1-to-1. You may be fine. Why? As long as they have a line of credit. That line of credit can supplement the shortfall, the small shortfall within this cash basis cash flow. Now, what would be a different example where it's just a shortfall? The first year is a 0.95. The next year is a 0.50. The third year, the debt coverage ratio is a 0.25. Well, how do you interpret 0.25? Wow, for every 25 cents coming in the front door, there's a full $1 going out the back. It's always $1 going out the back. They're bleeding to death. They're hemorrhaging. They are literally bleeding to death. Absolutely. But if they're just below the 1-to-1, may not be bad. They may be fine. Questions on this model? Matthew, any questions on this model? Any questions, Matthew?
I'm doing good over here. Thanks.
Good. Excellent. Thank you. Let's turn to page number 29. Our third and final cash basis cash flow model. Then we're going to do our little tack on, the two add tack ons, if you will, and then take our last break of the session. Then we'll come back, do our section 4 to advanced key ratios, and then get you on your way for the day, for the evening. Okay. Look at this fixed charge coverage, FCC. Look at the formula. In the numerator up above is the EBITDA, the traditional EBITDA we've covered extensively today. We then subtract off cash distributions and cash taxes. What we're really doing in this model is we're taking an EBITDA formula, which is accrual-based, and somewhat adjusting it into the world of cash basis by taking out the cash distributions and or the cash taxes. That's in the numerator. Look at the denominator right below current portion long-term debt or CPLTD. If you put the letter P, if you put the letter P down below, and then right below cash interest expense, you put the letter I. You can see this is converting EBITDA accrual-based to cash-based. So we have the P&I, we have the debt service. But what is the PP? I put in your notes prior period. The prior period. When George prepares a reviewed or audited statement, usually it's a higher level, not company prepared, and sometimes not even in CPA compiled, but a reviewed or audited, we talked about earlier. He will make an estimate. George will create an estimate known as the current portion long-term debt, which is the principal portion that will be paid out on the long-term debt when? In the next year. In the next year. So if he's trying to calculate the cash, the current portion long-term debt for year end 21 coming up 12/31/21, okay, fine. Puts on the balance sheet. But when is it paid out? In 22. So the interest expense, cash interest expense, is in the actual year. But the current portion long-term debt is staggered back a year, prior period. Let me illustrate. You're doing a cash flow model for 18, 19, and 20. Okay. Well, the debt service, the interest portion would be the interest expense for 18, 19, and 20. What about the current portion long-term debt? It would be from 17, 18, and 19. What? Why? Because those are respectfully paid out in the next period. Year end 17 is paid out when? In 18. Year end 18 paid out when? 19. 19 paid out when? 20. We want to match up timing wise the outlay of the cash. Remember, the spirit of the FCC calculation is a cash basis concept. Questions on fixed charge coverage? Hannah, any questions on this one? Any questions on the third? This is the third and final of our cash basis cash flow. Hannah, any questions on this? Okay. Brad, Christy, Carissa, any questions? If you can type into the chat, any questions? Okay, Christy says no. Okay, all right. Brad says no. Good. Thank you. Okay, now for our last shifting. We're still in our third section, cash flow, but we're going to do our two tack-ons, so to speak. The first is the free cash flow. I put this in your notes. Free cash flow is traditionally only done for large publicly traded corporations. Microsoft, General Motors, you name it. Walmart. Look at the formula down below. The inflow is NOPAT, stands for net operating profit after tax. Net operating profit after tax. Minus, of course, operating capital. You can see it, working capital, long-term assets. Traditionally, you do this analysis for a small to medium-sized borrower at your bank, you're going to have a negative number. This is almost exclusively used for large publicly traded corporations, although a few of you may have some pretty heavy hitters, large borrowers, large companies. You may want to look at this model, just a thought. Now let's go to our last cash flow model to turn forward to page number, there we go, page number 30.
I do have a question on that last
You
model.
bet, go ahead. And who's this?
Zach?
Zach, go ahead, Zach.
How large would you say, like dollar figure wise?
Oh, there's no set rule. I will say this, Zach, if it's publicly traded corporation, these are done usually every quarter and disclosed. Does that make sense? So that's a given. But for privately held, my opinion, if let's just throw out a number. You have a borrower that's getting up to, like my one CFO client, up to $100 million annual revenue. I would consider, that size client and above, definitely, I would look at this, at least look at it. Does that help, Zach?
Yeah, for sure. Thank you.
You're welcome. Page number 30, our last cash flow model, sensitivity analysis. This is a comprehensive analysis. This happens to be the loan request is a $5 million loan. I would circle or highlight the titles to each of these 6 categories. Do you see the 6 on the top there? Pardon me, steady state with the new loan, 10% drop in sales, all the way to the right. I love this analysis. Why? There is so much information on one page. Now, look at the first column. It's the steady state. It's the existing cash flow of the company without the new loan. Look at the very bottom of that column, 2.86. I'd circle or highlight that. Oh, look at that strong cash flow. Look to the right to the second column. Now the cash flow relative to or including the debt service of the new loan. Look how the debt coverage ratio drops down to the 2.13. I'd highlight or circle that. Still very strong, over 2 to 1. That's huge. Look at the third column. 10% drop in sales. Wow, look at the hit at the bottom. It's a 1.31. It's still above a 1.20. By the way, you would compare from column 3 on to the right. You don't compare to column 1, you compare to column 2, because from here on out, all of these columns have the debt service of the new loan. So you compare it to the 2.13, not the 2.86. Still a hit, but they're still above 1.2. Look at the fourth column, 10% drop in income, 1.95 versus the 2.13 at the bottom. Not bad, not bad. This column number 5 is the one that I find amazing. Look at the very bottom, 2.05. I'd highlight, circle or highlight, compared to the 2.13. Not much of a hit. Interest rates are extremely low. Most lenders are gone. It's just a matter of time. They're going to pop. And there's only one way, it's up. Well, there's a little hedge for you. Not bad, not that much of a hit on the cash flow. Lastly, the income shock is my favorite. I would put in your notes next to income shock, if you would please, stress test. Stress test the numbers. The Excel spreadsheet is built. You can see it forces it. A 0.99 at the bottom of the column. I'm slashed through that. It's just Excel rounded and say 1.0, a break even. But pushing the numbers back, if you look at footnote letter D at the very bottom left, what does it really tell us? This company could have a decrease in their cash flow of over 1.3 million, which is 54% hit or decrease, and still have a break even. Wow, that's powerful. Income shock, stress testing the numbers. Okay, let's do a quick class shout out, and then we're going to take our break. Quick class shout out. How many of you stress test the numbers in any way, shape, or form, like we see on that 6th column? Just yes or no, including in the chat, everybody.
Yes.
Yes.
Look at that.
No.
Most of you, few of you don't, most of you do. Brad does, Christy does in the chat. Excellent. Okay. Excellent. Good. Moving right along. My recommendation, one other thought, we take our break. My recommendation, if you don't have this type of a chart in your write-up, your loan write-up, I'd have it. But what I do is I'd have it at the back of the analysis or the back of the write-up right before the spreads. And then simply reference in your verbiage part of your financial analysis of your credit memo or loan write-up this information. Powerful. Let's go forward. Let's move forward. Okay, we'll stop right there. For the sake of time, let's just take a 3-minute stretch break. Let's take a 3-minute stretch break and come on back. We're going to do our 2 comprehensive models, and then we'll do a quick summary activity and get you on your way for the day. Talk to you in 3 minutes. Thank you, everyone. Welcome back, everyone, for our last little section. Heather, would you be able to do our sound check for us, please? Heather, if you're there.
Yep, we're good.
Great. Thank you, Heather. Great. Okay, now, Altman Z-score, bankruptcy predictor, and the sustainable growth model. Section number 4 of today's presentation. Now, what is this? This is a comprehensive key ratio. It was created originally in the late 1960s. It has been perfected ever since. In fact, I was at training a group of CPAs in the Detroit market just a few years ago. And this before the pandemic, of course. And one of the CFOs in the room slash CPAs came up to me after the end of the session and goes, do you want to see my Z-score analysis? I go, yeah. He was the CFO of a manufacturing firm in the Detroit market. And I said, yeah. He opens his laptop. He's got 10 years mapped out. Oh, graphics and all. It was great. Well, what is it? Comprehensive model. Is your borrower marching towards or away from bankruptcy? Well, you can see an example right here, and you can see the variables down below. You can see that, and I've highlighted. You notice because one of our major themes today, of course, is cash flow. Look at variable C. Look at that, and look at the weight, 3.3C. The largest variable. This should not be a surprise to anyone. The largest variable in this Altman Z-score, the bankruptcy predictor, which is bankruptcy is traditionally the worst thing that could happen to your borrower, is tied into the EBITDA divided by total assets. Now look down below. Do you see the D, the market value? Well, most of you, if not all of you, bank privately held small to medium-sized businesses like we've established. So I would slash under D, to the right, pardon me, I would slash through the word market and put book value. Okay. If there's a big publicly traded company, you do the market value. Altman Z-score. Now, how do we really read this? If you'll turn with me to page 32. Pardon me. These are the numbers from sample contractor. Now, whoa. Where'd you get these numbers? Everybody, if you'll hold your eyes, let's turn back. Just don't look at your screen, but turn back on your hard copy. Turn back about 5 pages to page number 26, the last page of the Moody's spreadsheet. Or it could be SageWorks or Baker Hill or your Excel. So turn back to page 26 in your hard copy. Do you see at the bottom left under activity? Do you see the Z-score and the numbers to the right? That's where I got them from. They're generated from the software in the key ratio page. So I'd highlight that whole line. And then at the very bottom on the left, do you see sustainable growth? I'd highlight that and the numbers to the right. Okay, now that's where I got them from. We're going to come back to sustainable growth in a moment as well. But it's generated by the software. Now, fast forward, turn forward in your page to page number 32. So turn back to page 32. I just want to show you where I got them from. These are the exact same numbers for the Altman Z-score that I had you highlight on the last page of the spreadsheet. You see the 2.92, the negative 9.3, and the over 8, almost 8, and so forth. Real numbers, real company. Now for the punchline. Look at the scale down below. If you have an Altman Z-score over 3, in theory, you're far from bankruptcy, meaning your borrower is. Gray zone 1.81 to 3, 0.1 to 1.8, bankruptcy characteristics, my slang terminology. I say that last one, 0 to 1.8, your borrower is in the death zone. Look at this company. This is a sample contractor. We just went through and analyzed the numbers just earlier, just a few minutes ago. Look what happened in 08. They were almost out of the bankruptcy characteristic. They weren't in bankruptcy, but they were far from it. Almost. They're still in the gray zone, but not by much. Look what happened in 09. Remember I mentioned this earlier? 09, the Great Recession finally grabbed this customer. Whoa. Look at 10, 11. These are real numbers. Did they survive the Great Recession? Oh, absolutely. What was the difference from 09 to 10? I went to the owner and I said it politely. And now I was their CFO. I wasn't their banker. I was their CFO. I said, you're going to file BK if you don't do something significant to change the course of the business. Oh, no, wait. Oh, no, wait. Oh, no. I say, yes. So he took it to heart. Finally, what did he do? Laid off some non-productive employees, had about 18 employees, dropped it down to about 14, 15. But that was not the biggest. The biggest was they started to bid the jobs. This is, remember, the fire, the flood, you know, the cleanup, if you will, in a home fire, a business fire in the office. They started to bid the jobs tighter. They started delivering in the field. Before this, they get a big dumpster. Oh, any excess goes in the dumpster. Not now, not in 10. Oh, no way. They survive. Now, if you go back to page number 31, just flip back one page. What if your bank, you use Excel? Several of you use Excel. You don't have Moody's or SageWorks or what have you that has potentially the Altman Z-score embedded within the key ratio page. Like I pointed out a few pages back in the spread. Okay. I put this in that blank spot right there on page 31. If you're using Excel, all you have to do is Google Altman Z-score. Do not Google Z-score. You'll get the Z-score you may remember from your statistics class, stats class from years back in college. You Google Altman Z-score, ALTMAN. You will get free of charge Excel-based templates. Now you have to plug in the variables you can see on the left, bottom left. And some of them may be exactly like this, some may be a little different, but you can do it. Plug it in and calculate your own Z-score. My recommendation at the very bottom or end of your financial analysis section of your write-up, after the cash flow, remember the C of cash flow is the end, the crescendo. I put a little chart, just build a little chart. Year in 18, 19, 20, interim 6/30 of 21, and so forth. Just a thought, maybe even quarter to quarter. First quarter to first quarter for 3 years, or a combination of the above. You can do it. Now, this isn't perfect. None of these models are perfect. The current ratio is not perfect. Any of these models, the cash conversion cycle is not perfect. None of them. But this, like most of those, are indicators of the financial strength or weakness of your borrower. Turn the page, if you would, please. Turn forward. Page number 33, sustainable growth. I showed you where I got those numbers from. We'll see those in a moment. Go ahead. There's a question. Go ahead.
Yeah, I'm just curious. And maybe I missed it. What's the scope of your bankruptcy predictor? Like
the timeline.
Yeah, the timeline. I'd say for how long is that rating good?
Okay, you mean like, for example, there as far as I'm aware, that's a very good question. As far as I'm aware, there is no specific time frame saying you will go BK, but I will say this, with my CFO clients today and over the last several years, if they get into the 0 to 1.8 category, as you see on page 32 here, and if they do not make drastic, significant moves or management changes within the company, changing the operation, changing something, it's a matter of what I've seen. It's usually within 3-4 months, they're gone. They're BK. Sometimes some may be more like 6 months. There's no way. But if they're in that bottom category, they got to move. They've got to move now to make the change. Does that make sense?
Yes, it does. Thank you.
You bet. You're welcome. Good question. Page number 33, our last model, sustainable growth. This is sustainable growth. How much can the company grow sales-wise internally without any outside support? If you would please highlight that little middle paragraph there, says in order to grow faster. You can see that, right? That little paragraph. This model, quote unquote, assumes no more equity, meaning investment from stockholders or even owners, if it's privately held. No increase in financial leverage, which is referring to debt, new loans from the bank or other source, and no improvement to the profit margin. It's kind of what if scenario. You turn with me to page 34. These are the numbers from sample contractor. 107% between 08 to 9, then 63%, then eventually goes into the negative. This is common. Even large publicly traded corporations like Walmart, they need outside debt and equity. Debt, we talked about it earlier, way earlier today. Bonds, equity, new common stock to support their growth in sales. This sustainable growth model ties into their internal, can they support sales-wise? So even a Walmart would basically have this similar type of a trend if you excluded any of the bond issues or new common stock equity issues. Kind of an interesting model to see, to look at. Of these two, though, the advanced Altman Z-score and sustainable growth model, Altman Z-score from a credit standpoint, all the way important, in my opinion, from a commercial loan underwriting. Now, is it perfect? No. I've had a few lenders say, I talked to my boss, my credit administrator, or my boss, Altman Z-score. They don't want us to look at it. Well, why not? Well, they say it's not reliable. Well, I beg to differ. My experience as a CFO, it's reliable. Last time I had a customer say to me, this is real client, real life. Oh, I don't believe in that stuff. No, not sample contractor. Well, we turned the corner and believed in it. They survived. This customer says, I don't believe in that. 4 months later, less than 4 months later, he called me. We got to go to lunch today. Sure enough, we sat down. Well, kind of hung his head. I had to file last night. Well, what does that mean to file? File bankruptcy. Just a thought. Now, in conclusion, you turn with me forward. Just a kind of an interesting little model. Then we're going to do our quick last activity and conclude. Look beyond the numbers. Companies' revenues tied to one key customer. I'd highlight or circle. Wow, that's risk. We may not see that unless we really talk and work with Jane closely, the CFO, and or the owners, Bob and Sue. Look at part B. I'd highlight to the right one key product. Under part C, I'd highlight a single supplier. Wow. These are risk factors that don't show up in the numbers until it's almost too late, if you will. Look at part D. What about business generated overseas? There's nothing wrong with doing business overseas if they've got the experience and the know-how and the team to do it. But what if they don't? Look at part E and part F kind of combine competition and future prospects. Wow. In the marketplace. And I'd add off to the side to the left of E and F, is the market turning? Is the market changing? How could that impact Bob and Sue's operation, ABC LLC? Lastly, look at part G, legal and regulatory environment I'd highlight. We often fixate within the bank. Oh, where are regulations, the banking regs we have to adhere to? Not remembering or realizing that most of your borrowers, depending on the industry, they have certain regulations to adhere to. Now, they're not the same as the banking, but it may be OSHA for safety or all sorts of different regulatory and regulators, if you will, that they have to deal with. Absolutely. Okay, now in conclusion, what I'd like everyone to do is spend just a moment on this. Go back through the material. Like to have you pick out one takeaway from the accounting section we covered. The accounting section, meaning looking at the financial statements, but more from the accounting section. And then one takeaway from that section 1 of our 4 sections, and then one takeaway from section 2, the laylock, section 3, cash basis cash flow and other cash flow models, and section 4, the 2 advanced models, Altman Z-score and sustainable growth. So 1 from that first section, emphasizing, and I just encourage you, spend a little more time on that accounting side to really understand the inflow or the input. What are you receiving from the company? And then 1 from section, not each, but just 1 from section 2, 3, and 4. So just 2 takeaways. Just keep it simple. 1 from section 1, and then another 1 from either sections 2, 3, or 4. What takeaway that will benefit you? And we'll go ahead. We're going to do the first one. I'll go through the list of everyone, and then we'll go back and do the second one. So 1 takeaway from that first section, the accounting section, and 1 just combine sections 2, 3, and 4, just 1 within that area. Okay, take just another moment or so. Write these down at the bottom of page 35, if you will. 2 takeaways from today's session. Okay, take just a moment, please. Pardon me. There's no right or wrong to this, by the way. Just whatever, just you think, wow, that's a takeaway for me from today's session. You bet. Okay, here we go. Jordan, from the accounting, that first section, the financial statement analysis, where we touched on the accounting, what's 1 takeaway from today's session for you?
Yeah, I was thinking about the discussion on the 10-step accounting cycle and the important questions to ask there and what to take away, whether to request additional info or what questions to ask on the information you're actually getting.
Good, good. Dwight, how about you? Dwight, do you have 1 takeaway from that first section?
Yeah, our little group here was saying that actually the same as Jordan about the different questions that you can ask with the different types of financial statements you get, especially since we mostly just get like tax returns and like reviewed statements here.
Gotcha. Thank you. Charisma, how about you? Charisma?
I'll have to say the same thing. Just kind of validating the numbers they've given you to make sure that they are what you assume they are, or what's included in those numbers.
Okay.
Whether
good.
it's business, personal, things like that, to make sure you're actually looking at the picture of the business and not something that they've kind of added a little bit to make things look better.
Good. Catherine Lee, how about you? What's 1 from that first section?
Kind of going along the same lines, just making sure we're asking questions so that way we can relay the appropriate information to the lender.
Good. Ryan, how about you from that first section?
I'm the same because I never really thought about like asking for journal entries and whatnot from the borrower.
Okay, good. Joey, please. Joey, Merlino, please. What is 1 from you?
Yeah, I think that section 179 thing we covered is really interesting. I don't know too much about it, so it's definitely something I want to talk to my COO or someone above about and just see what their take is on it and see what we really do covering.
Good. Good how you actually do it. Good. Evan, how about you? 1 from that first section. Evan? Okay, Catherine Walker, I know we've had some technical there. Catherine Walker, what about you from that first section?
Same thing, kind of like to go back and ask some questions. And one that I really like that you had mentioned is, how do you audit? How do you audit to get, your numbers? So that way it gives us maybe a little bit more information on how they do their audit. Also, that gives us maybe that in turn would probably answer some questions for us.
Good, good. Jeremy, how about you? 1 item from that first section.
Yeah, I kind of along the same lines. I just like the idea of instead of just taking the financial statements as they are, to really look behind it, not only asking those questions to verify the information, but also kind of looking at the accounting choices that they're making there and how those might modify the numbers that you're actually seeing, and making sure you understand the whole story behind that.
Okay. Matthew, how about you in that first section?
I was looking at the 10-step accounting cycle as well. I specifically like the discussion about the adjusting entries and asking for more details in that regard.
Okay. Hannah, how about you in that first section?
Yeah, what I thought was really interesting is thinking about your borrower as another lender, and how on the balance sheet, it's important to distinguish that maybe your business that you're working with doesn't own their equipment that will show up as capital, but technically the bank owns it and it still shows up on their balance sheet. So I thought that was a really important distinction too.
Good. Thank you. And Brad, Christy, and Carissa, let's see. We've already got some in the chat. If you would input this. Okay. This is from Brad, section 1. Garbage in, garbage out. I love it. The company's financial statements. Good. And also the section 179. Christy says the 10-step accounting cycle. Good. All right. Thank you. Heather, how about you for that first section?
Mine was the section 179 to look at that differently versus
Okay.
adding it back in.
Good. Thank you. James, how about you from that first section?
There's a comment you made earlier from a collateral standpoint. If the customer is using the LIFO method,
yes,
we might have some hidden equity in
which is a
inventory there.
positive. That's a good. That's a positive. Good. Moving right along. Alexa, you can type into the chat while we wait on that. Zach, what about you? The first section.
Mine is the 10-step accounting cycle, like several others, like the whole garbage in, garbage out, looking at the transactions and understanding more beyond just the financial statements that we request from them.
Okay. And Angela, how about you for section number 1? Any thoughts on that?
I would say the same as what Zach and others said about the garbage in, garbage out, and watching.
Good. Thank you on that. Okay, number 2, it can be on section 2, the laylock model, section 3, the cash basis, cash flow, and a few of those other models, including sensitivity analysis, and or section 4, which is the Altman Z-score and or the sustainable growth models. One takeaway from those 3 sections, and we can repeat that if someone's already said it, that's fine. Jordan, what would be your one takeaway from that sections 2, 3, and 4?
I like the 2 add-ons at the end, especially the Z-score. I know it's something we have in our financial ratios, but it's not something we often talk about.
Okay, great.
So yeah, it's something that we can expand on a little more and have discussions about.
Okay, great. Dwight, how about you?
Yeah, partially with Jordan. I'd like just the Z-score actually from him, and I wish the bank I work for actually took it in more into account to our analysts.
Okay, thank you. Charisma, how about you? Charisma, how about you? Yours.
I also like looking at the Z-score. That's something that we don't use. I'm not sure if it's something that I can kind of get us to use across the board. Another one is the stress testing. Obviously, I've known what it is and I've discussed it, but to see like a good breakdown like that of a type of stress testing, I think that would be valuable for us to use in some of the analysis.
Good, thank you. Catherine, how about you? Catherine Lee, how about you?
I always find the Z-score interesting on when we talk about it, but the conversation on how PPP loan is taken into account across different financial institutions.
Good, that was good, good. Ryan, how about you?
I found the Z-score interesting because we use Baker Hill and it's always there, but we never really talk about it in our actual sheets. So
good. Okay. Joey, how about you?
Yeah, I liked when we were covering the UCA statements and we talked about how you want your borrowers to finance their current assets with current liabilities and then long-term assets with their long-term liabilities. I thought that was a pretty good and interesting point.
Good. Thank you. Evan, how about you? Evan? Catherine Walker, how about you?
Also kind of agree with the Z-score, because we do not use that, and it would maybe be another component that we could kind of look at a little bit. Just give us a broader and bigger picture in the long run.
Okay, thank you. Jeremy, how about you in your world? What's a takeaway that will benefit you from sections 2, 3, and 4?
Yeah, I like some of the advanced cash flow models we did just because they're a little closer to cash than EBITDA. That's maybe more of a estimation. And also like looking at the sustainable growth rate. I remember that from, finance classes at school that but kind of thinking how it could be applied to commercial lending and, specifically that last slide where it says it could be a check if business plans are reasonable if you're looking at forecasts or something along those lines.
Good, thank you. Matthew, how about you?
I also appreciated the Z-score. I think it's something that our bank could use, and it'd be nice.
Okay, all right, thank you. Hannah, how about you?
I found it valuable to talk about the Z-score as well and determining that.
Okay, thank you. And Brad, Christy, Carissa, if you can type into the chat, if you would. It's right here. We've got it. Christy's learning more. Okay, 5-step model. The 5-step model, short-term, long-term analysis. Excellent. Good. Okay. And Heather, how about you? In our second section, how about you?
The Z-score as well. We don't use that, and
Z-score.
I think that'd be beneficial.
Okay. James, in that second section.
I really liked your 2 concepts you had when you brought up that we should look at our customers to finance their short-term assets with short-term liability and the long-term.
Good. Thank you.
Good concept.
Okay, thank you. Brad says in the chat, cash conversion cycle. Thank you, Brad. You bet. Alexa, how about you in the chat? And while we wait on that, Zach, what would be your second item?
I guess mine would be a 2-parter. I was intrigued about the free cash flow portion and then the Z-score as well.
Okay, good. And Angela, what about you?
I would say the Z-score, and then talking about the PPP funds conversation too. I found that interesting.
Good, and we're going to see that in the tax code because we have tomorrow in Exhibit 3, the tax code starting the changes from year-end 17 all the way till today in tomorrow's session. Excellent. Well, with that, I want to thank each of you for attending today's session. This was excellent participation and very, very good review or summary at the very end. As we started out, please, if I can help you, send me an email. I'd be glad to help you and work with you. With that, everyone have a good evening. And for many of you, I'll talk to you tomorrow. Thank you so much.
Thank you, David. Thanks, everyone.
Thank you. Good night. Thank you, Stephanie.
Thank you.
Good night. Talk to you in the morning.
Okay.
Thank you, everyone.
See you tomorrow.
Thank you.